Well, welcome everybody to our YouTube event. It's a live event. Today we're going to talk about the second half outlook, 7 ways to beat the market. I'm Roger Michalski, publisher of Eagle Financial Publications. I'm so thrilled to be here today. This is our 3rd live YouTube event. Got lots of great feedback from the first 2, so that's why we're doing it again. We're going to be here for a while today. First, we're going to kick it off with a panel of everybody you see on here, but also then we're going to have 7 presentations today, so we'll be going from 12 to 6 o'clock today. So I will be your host the entire day. Very much looking forward to it. But before we jump into the panel, I want to mention that this month, May of 2023, is the 20th anniversary of Eagle Financial Publications. I started Eagle Financial Publications 20 years ago this month. Mark, it was just you and I back then, and you only had 1 publication at the time, Forecasts and Strategies. So it's been an unbelievable 20 years. I've got 2 daughters of myself, and I call Eagle Financial Publications my 3rd daughter because this really is my family as well, and just so happy of what we've been able to do and all the education and great advice we've given over the 20 years. So we're going to celebrate that a little bit today, and through the presentations, we're going to have 20th anniversary specials for various products. And on top of that, anybody who orders anything today, we have a special report that I asked all of these guys to give me a couple of their best tips and secrets that they've learned through the years. So we have a special report for anything that comes with anything you buy today that has all those tips and secrets from these guys. So yeah, looking forward to a terrific day. So we've got with us George Gilder, Bryan Perry, Bob Carlson, Mark Skousen, Jim Woods, and John Johnson, with yours truly, again, Roger Michalski. And so let's kick it off. The title of this whole day is the second half outlook. So first question, how will the market perform in the second half of this year? And as I told these guys, just going to let them jump in. So if anybody wants to jump in and give their predictions for the second half, go for it.
Well, let me just first of all just say congratulations to Roger. I think that's fantastic. And what's amazing is after 20 years, you still look as young as ever. I don't think you ever age.
So I was 9 when we started, so yeah.
And I'm kind of hopeful that your score. I know a lot of people don't know this, but you're quite a successful bowler, having bowled 300 a number of times, and I know a number of our people here today have had that kind of results in a string of profitable trades. I think all of us have done this from one time to another, and so I'm kind of hopeful that in the second half of this year, we'll be able to get that put together some really good returns for you, the subscribers to our services. You pay a lot of money for these services, and we really work hard to fulfill those goals. And my outlook for the second half is actually a bit more optimistic than the first half, because the first half is still continuing dealing with a lot of uncertainties of rising inflation, rising interest rates. We have this debt ceiling debate going on, the war in Iraq. I mean, you can just go on and on. A lot of bugbears that are out there that I think will kind of resolve themselves in the second half. And in fact, I think Bryan was telling me this, that technically during the cycle, the year after the midterm elections is really a good year for the stock market. But it's usually the second half of the year where we really get a booming year's return on our investments. So I'm really counting on more of a bullish trend as we move into the second half.
I'll dovetail that with a couple items here on what we're seeing right now with the debt ceiling negotiations happening. We're going to see, the Biden administration and McCarthy and all the lawyers get in the middle of all this. Typically, you don't bring the principals back into the to the bargaining table unless the staff has made some progress. So I'm looking for some progress on the debt ceiling here, and that's, you know, we there's like 3 or 4 major headwinds which Mark, you know, noted here. We've got the Fed here, which you know, currently the Fed Watch tool is looking for about an 80% chance that they're going to pause here at the June 4th FOMC meeting. That would be another headwind out of the way. You know, certainly with the debt ceiling out of the way, that would be 2. Inflation is the boogeyman. That's still where we're starting to see some lower revisions in jobs numbers coming in from the last month here. CPI and PPI both came in below forecast. And now we're starting to see, you know, consumer sentiment last Friday was definitely down, you know, as opposed to forecast. And New York City or the New York Empire Manufacturing Index was very, very dour. And so business optimism has definitely taken a hit. So I think that, you know, there's time to consider the Fed, you know, and you got the newest Fed Governor Austin Goolsbee is talking that they should pause, and how the Fed doesn't want to come out and ultimately say that until the meeting happens. But I think the market's starting to buy into it, and the market's starting to also look for the Fed to pivot and start to lower rates by maybe 100 basis points late in the year, probably into the first quarter of next year. But the market's a forward discounting mechanism, and it's going to look 6 to 9 months out. And therefore, we should see in the wake of, you know, where we get this recessionary talk starts to build and starts to weigh on further on sentiment here. That's usually when the best bargains are out there in the market, and that's usually when you start to see the market bottom start to be put in place. There's a lot happening between now and summer. Summer's always squirrely. It's never the best time to be long the market. You know, your most of your money's made in the first quarter and the fourth quarter, and so therefore this could be a long hot summer of uncertainty. But I think that once we're through these 2 or 3 items here with the debt ceiling and the Fed and the next set of inflation numbers, I think there's a good chance here that the market's going to start to catch a bid. And we've already seen that in the tech sector and some of the growth stocks. Obviously, there's a lot happening in the tech sector, camping out there as a safety trade. But I'm optimistic as well, and I think that the market's going to find its way higher from current levels here by year end.
Yeah, Roger, I'll jump in here with a follow-up on Bryan's commentary on the Fed. So I just checked the latest Fed funds futures, 80%, near 80% chance of a cut at the September meeting. That's what the futures are saying. And I tend to think that could be accurate, because that's when we're going to really start seeing a little bit of economic slowing. Finally, we're starting to see a little bit of it now. There was a horrible Empire State Manufacturing report that came out this week. And that was very stagflationary, because it still had prices higher, but the activity was down. So the Fed's going to need to combat that kind of stagflation if that happens. And that's always bad for stocks. Now, with respect to the debt ceiling, if we look at what happened in the 2011 debt ceiling brinksmanship, it was bad for stocks going in the middle of it, and coming out of it. Stocks took a while to actually come back after that. So I did a little digging and saw it was a 17.4% decline in that roughly 4-month period where the debt ceiling was the biggest issue on the table. And that is not good. The Russell 2000 was down almost 25% over that same period. So if history is any guide, you know, we're in for some kind of that long hot summer that Bryan mentioned. And you know, Washington's not going to do a deal until there's actually the very last minute, because it's politically expedient for them to do that. It makes good political headlines for them to keep it in the news and to keep it flooring, because they want something. They want to show everyone that they're like battling the good fight, you know, for the citizens and that kind of stuff. So for whatever that's worth, but overall, I think I agree with Mark and Bryan when it comes to being optimistic for the second half. A lot of this stuff is going to be resolved by later in the year, and we could be looking at a huge opportunity to get in these markets in the second half. We've already had a good first half of the year for certain sectors. I know we'll talk about that in a minute, but the market right now, the pain trade right now is higher. And once that pain kind of starts to diminish, it's going to be even higher. So I'm characteristically bullish, but I think for good reasons at this moment. So I'm curious to think what everyone else has to say on that.
Well, if I can jump in, I just say, oh, go ahead. Go ahead.
I think we're in life after capitalism. and as long as the politicians pursue their suicide pact, dismantling the U.S. economy, rendering the power grid frail and inefficient and vulnerable to sabotage, as long as the politicians attack the economy across the board, I don't think we got any prospects here, regardless of what the Fed does. The Fed is just a great alibi. Everybody, it's amazing that the politicians got us all talking about the Fed when they're assaulting capitalism at its core. And this is the real problem. So I focus on individual companies, and the lower the prices are, the better for me. And so I think that this era is going to be very good for entrepreneurs. And we got to look for pursuing really new technologies. I think we're moving into a new carbon age, spearheaded by graphene, and which is a new material that is 200 times stronger than steel and 1,000 times more conductive than copper, that is just will transform our economy in coming years. But first, we got to forget about the Fed. The Fed's not going to save us. It really won't. It's an alibi rather than an opportunity.
Well, I will say that it is difficult right now for entrepreneurs to get going. The capital is not as available, and there's a lot more regulation on them. I know I've got some in my family who are trying to get going, and it's more difficult. But getting back more to what we think is going to happen in the second half for me, what strikes me is this market, there's so many bad things out there, and it's almost absurdly resilient. I mean, it's down. I get that. But in my book, it should be down a lot more than it is. And I think, and I've pondered this a lot, and one of the things that I've seen is that a lot of the people who are in the market now have only been here since 2009. I talked to a lot of people who haven't been here since, and it's all been Fed liquidity. That's what it's been about, and that's what's propped up the market for all those years. And they are absolutely certain that the Fed will come to the rescue of the market. They are absolutely certain that's going to happen. And that's why I believe we're getting these forecasts that we're going to have Fed cuts and what have you. I know the Fed funds future is very accurate. And I may be talking in my shoe here, but I think that that's one of the reasons the market hasn't gone down. And if it can weather all what's happening right now and still maintain, we're bumping up against recovery highs right now. And if we can keep doing that, then yeah, I think we may have a typical Q4 coming up. Like it or not, regardless of what the situation is, we may get a typical Q4. Now, I think everyone else hit the nail on the head. The Fed is superfluous, and it's not, because it controls money supply and that type of thing. And it depends on what the Fed really wants to do. If it wants to fight inflation, or if it wants to bail things out. And we'll get to this in a little bit on another question. I have some pretty strong opinions about that. But I feel kind of good about Q4, which everything says don't. But what I'm seeing, I got to park your guts at the door and go with what you're seeing. And for me, that's we could have a pretty good Q4.
All right, so Bob's always, it's always hard for Bob to get into these discussions because he's a little more or is it laid back? So Bob, go for it.
Yeah, I'm a little more pessimistic than most of the others. I think I've been saying for about a year that inflation is going to be much stickier and more persistent than the markets and the Fed have thought. And I think that's still the case. I think the Fed has a lot more work to do. And it might pause now because there are some signs of a slowdown, but it's going to have to keep money tight. It's not going to loosen. If you look at the futures markets, they're expecting the Fed's going to start cutting rates pretty soon, which they've really been expecting for some time, and they've been wrong. I think they're going to continue to be wrong. The only thing that might prevent that might cause the Fed to start loosening quickly is if this banking crisis continues to unroll, and there's a lot of potential for that, and then it might decide it needs to save the banking system, even if that allows inflation to stay well above its target. So I think that's going to be the trade-off in the second half of the year is how bad is the bank situation going to get versus how quickly will inflation come down? And I don't think inflation is going to come down quickly. I think it's going to be a kind of a slow, steady drop. And unless the Fed decides it needs to kind of rescue the banking system and the economy, I think it's going to be staying tight well into the rest of this year.
All right, well, I'm going to go a little off script on some of the questions that we asked and jump ahead, seeing as you just talked about the banking crisis. So I want to hear from others, and I actually want to start with Mark. Is the banking crisis over? Are more banks going to go under, and what kind of impact is that going to have? If that happens, what's that going to happen to the market? So Mark, I'll start with you on this one.
The banking crisis is one that I anticipated. I thought that the Fed can't adopt a tight money policy after 10 years of an easy money policy without causing problems. And I've always thought there's an old saying on Wall Street, there's never one cockroach. There's always a lot of these out there, and the regional banks are seeing that now. I believe there's over 50 banks that have gone under. Most of them are smaller banks, but a few on the headlines. And a lot of banks are facing the same trouble, even though the Fed has agreed to bail out all depositors, even over $250,000. It has not stopped a lot of depositors from taking their money out of the small banks because they know that if your bank goes under, you don't get that money. It's not liquid right away. It does take a while to get that money out. So that's a serious problem. So if the banking crisis is over, then that's good news for the Fed policy. But I'm kind of in Bob's camp here, that thinking that maybe we haven't seen the full impact of the banking crisis. I am actually, in terms of the market, looking for some positive. We have some positions in my 5-star trader in lithium, for example. We're up 6% just in the last week. It does seem like lithium, the bear market of lithium is over, and that's a necessary part of this after capitalism role that the alternative energy. I don't know if George is really advocating a case against fossil fuels, but I actually think fossil fuels.
I certainly am not.
Okay.
I'm for fossil fuels. They run our economy. I'm for a new carbon age. I think we're going to have a new carbon age that is going to sweep away all this alternative nonsense and suicide pacts of climate change hallucinations. And I think we're in a new technology era that goes beyond Silicon Valley, that's given into the suicide cult, and is going to crop up around the world. I spend a lot of time in Israel these days pursuing new companies in Israel, which is spearheading the graphene movement, among other important causes. So
George, let me ask you, what about copper? Because I think that's probably something we can both agree on, that the demand for copper will continue to rise. Do you buy that?
I think the demand for copper it will continue to rise. Yes.
So we have a position in that as well. Yeah.
Graphene eventually is, however, 1,000 times more conductive than copper, but it can't usurp all the roles of copper. But a company called Universal Matter can now produce graphene by the ton. So the future of electronic creativity and entrepreneurship will be in new materials. But for now, surely copper continues to be a good material. And as we electrify stuff, we got to use copper.
One thing
certainly agree with George.
All our experts, they just, they just hide their feelings. That's one thing I just love about you guys.
Graphene spray wax for my bike. There you go.
Oh, good. All right.
There you go. A new use. There's 1,000,001 uses.
There you go. Well, so John, I saw you when Mark was talking about the banks, and George, you were kind of shaking your head. So what are your thoughts on that?
I'm not demonstrative at all. No, I think there's going to be serious issues. One of my favorite sarcasm lines in my newsletters is that, but of course, everything is sound and resilient. And I don't think so. I think there's going to be a lot of bank failures. I think there's going to be a couple of huge bank failures. And, it's just the creature that we have created since 2009, actually even before that. And it's going to be, there's, I think, a desired consolidation in the banking industry. Our entire country, I think George is getting at this, we're consolidating into more easily controlled numbers. And I think that's the plan for the financial industry as well.
We've nationalized the banks. I don't know if people have noticed, but banks that have been nationalized, they're no longer a capitalist force in the economy.
The small banks can't survive in that situation, and they won't.
Well, they're not completely nationalized because both the investors and the bondholders lost completely. The depositors came out whole, but not the investors and not the bondholders.
Buying off the masses.
So there's still risk. And this is why investors are getting out of these bonds. Although we in the Home Run Trader, we just bought, I think there's buy when there's blood running in the streets. And there are some pretty good regional banks that are in good financial shape, and those are worth buying at these levels, in my opinion.
I think the issue with banks right now is that we don't know, obviously we don't know the extent of it, although we all anticipate there's going to be, the more cockroach thesis. But think of it this way, if the banks come under greater and greater scrutiny, especially the regionals like they're going to, and if people keep on removing deposits out of safety like they did at PacWest, which caused a big decline in that stock, then you're going to see that effect. It'll be another negative effect on economic growth because they're not going to lend like they used to.
Yep.
And when they don't lend like they used to, you're not going to see you're not going to get that tailwind that we're anticipating in the second half. So that could be something a stumble that causes the wider market to get squirrely and for economic growth to slow. And perversely, of course, that may make the Fed act a little bit faster too. So, I mean, we're at the mercy of these forces, and whether we like it or not, and I know we all don't like that, but we have to be on top of these things because it affects everyone's money, especially our subscribers, and we're nothing if not stewards of that. So keep that headwind in mind as a potential very big negative for the markets going forward.
Invest in cockroaches, right?
They will never go away. That's for sure. They will never go away.
What's that ticker?
Each cockroach has 1 million neurons in its brain. Those cockroaches are smart. Follow them.
Some of those cockroaches are running the banks out there, you know, so we've got to
Right.
be mindful of all that because, you know, in the Berkshire Hathaway shareholder meeting, Charlie Munger gave a wonderful piece of advice. He said, you know, bankers should be thinking more like engineers. You know, they should be fearful about what can go wrong, as opposed to these wealth management guys in there, which are always out there taking more risk than they should. Yeah, just you know, the data speaks to the point of the commercial real estate situation, which everyone talks about, but no one puts a lot of hard numbers to it. You know, currently smaller banks hold about $2.3 trillion worth of the real estate loan, the commercial real estate debt out there, which is 80% of commercial mortgages held by all banks. So bear that in mind. 270 billion of that comes due this year. And so with valuations lower than where they were when these buildings were mortgaged, you know, originally, then, you know, you've got a loan to value problem with the commercial real estate market now, which is actually $2.2 trillion lower than book value. So this is going to unfold, not at one time like the run on deposits, but it starts this year. And if interest rates don't come down and real estate and something doesn't happen more materially positive with the commercial real estate market, then the problem is there. Then you've got an issue of trying to refinance all these mortgages at higher rates with lower occupancy levels. You know, right now in New York City, the occupancy level is equivalent of 37 Empire State Buildings, just to give you a reference point. It's 48% of New York City is seeing a vacancy rate. So, and that's not going away, I don't believe, anytime soon. And this is a problem with the new remote economy and just with, in general, how dangerous it is to live in some of these cities now. People don't want to commute. So this is a cultural thing, and it's really going to be interesting how the banks manage their way through the next phase of what could be a very long workout for the sector itself. You know, and it's going to take a lot more smarter people in there than currently are running, I think, some of these regional banks and these smaller community banks. So we need them for Main Street purposes. You know, these are your local banks that know the customers, that know the businesses, that know the communities. And yet at the same time, I think roughly 256 of these banks average failure every year. So it's an interesting time here, but the market's, you know, seeing a little bit of a bid here in the regionals the last 3 days. And it tends to turn a blind eye to it to some extent. But this is a larger looming, you know, unfolding trend that we all need to be very careful of in terms of what's the next big shoe to drop, if it's going to drop at all. Okay?
Hey, Bryan, those are some great points. And, you know, the numbers that you were throwing out there, I just had a flashback. I was a young lawyer coming out of law school, and we were working on this thing called the S&L crisis in Texas. And the numbers you're throwing out there started jogging my brain, and they are reminiscent of the numbers we were talking about back then. And that was a devastating collapse for Texas and the South. And if we're talking something like that, it puts a completely different perspective on things. Talking about the charts of these banks too, I'm big into technicals, and you know, I'm getting ready to short a bunch of regional banks again. So they're coming up to a resistance level. They've started a downtrend. So I'm not confident about them. I think I've already made that clear. It's just for me a question of how bad it gets, and these numbers Bryan was throwing out there, it brings it home a little bit more how serious this crisis is.
All right, let's move over to sectors for the second half of the year. So let's start with Jim. So what sectors are you looking for that will be good investments in the second half of the year?
Yeah, I think here it's helpful to look at what happened in 2022 and what's happened so far in 2023. So in 2022, of course, we all know it was a bad year, but it was particularly bad for consumer discretionary, down 37%. It was horrible for information technology, down 28%. and for telecom services down nearly 40%. Now, conversely, in 2022, we had energy, which was up 65%. Okay, and that was basically the only sector that really showed any kind of promise. Now, I recall on one of our early events earlier in the year, I don't know if it was a conference call that Mark and I had for subscribers, but we talked about how what usually is worst in the previous year ends up oftentimes being, the best performers this year or the following year. And so far, we've seen that to be exactly the case. Telecommunication services up nearly 22% year to date. Discretionary up almost 14% year to date. And technology, just the broadest base, XLK ETF, up nearly 22% year to date. Conversely, energy down 8%. Okay? And so we're certainly seeing, a reversal of fortune in all of these different sectors. Now, my suspicion is that you're going to continue to see upside in those sectors that we've seen upside in this year. I don't see energy breaking out in any kind of a big way from here to the end of the year, especially with recession worries and inflation, things like that. The headwinds there are still there. Financials, of course, we all spoke about that earlier. Industrials, possibly, that could possibly be a good sector for the remaining half of the year. Materials maybe as well. But if you're looking at technicals and if you're looking at fundamentals and where the money flow is going, the current three sectors that I like are communication services, ticker symbol will be XLC if you're looking at ETFs. Consumer discretionary, XLY is a symbol there, and technology, XLK. Those are the three best performing so far. And I suspect that the reason why is because money is rotating into where it's treated best. And I think it'll continue to do that, barring some, disastrous development with a debt ceiling or something, some other thing like that. So those are the three best performers. I think those are the three that are going to continue to see money flows, at least for the second half.
All right, who else would like to jump in on sectors for the second half?
Okay. Too much of a pause there. I like the big tech, the biggest of the tech, because I think they're too big to fail, like too big to fail banks. I think they're being used for several things. I think Bryan alluded to it earlier about the safety trade, and they got a good thing going with the government, and they're going to be protected. And it's a good place to put money where they've been performing. And Jim is exactly right. That money's going to follow money on that one. Now, at the same time, I think a lot of it depends on what the Fed ends up doing and what its motives really are. If it truly wants to fight inflation, or if it just is going to fall back on 12 years before and bail markets out if there's in trouble. I have a feeling that the Fed is not going to really, it's going to fight inflation more. I think the powers that it serves and its mandate to protect the system that exists are going to force it to fight inflation, and it's been a really difficult situation to do that. How much it can raise rates versus cutting the money supply, and how much is going to impact the big players that are infected by the low interest rate policy for so many years. But I think if that happens, you'll continue to look at the big techs as safety. And then defensive names. It's weird, I know, doesn't make a lot of sense. But if the Fed's going to fight inflation, there's going to be defense out there. And I look at some of the personal products that have been performing well. Boring stocks, Clorox, Colgate, Procter & Gamble, but they've been performing well. And then maybe some of the precious metals are being tested right now. We'll see what happens. But a lot of that depends, as I said, on what the Fed's and how it's going to fight and what it's going to fight.
I'd like to suggest, playing off of what John said about the Fed fighting inflation and maybe continuing to raise rates, I've been recommending for the first time in decades a money market fund. Where the Charles Schwab money market fund is 4.9% right now, just sitting there earning interest income, and that's competing now. It's finally starting to compete against bonds, against low dividend paying and growth stocks that don't pay any dividends. And if this banking crisis continues to fester, a lot can be said for having some of your money in a money market fund. The other sector that I really like is infrastructure. My infrastructure fund, based out of Toronto, New York, that's the largest infrastructure investment in the world. This fund is up, I think 17, maybe 20% this year. And this is one area where Republicans and Democrats seem to agree that we need to invest in our infrastructure and catch up with the third world, because our country's infrastructure and grid, as George knows, is an absolute disaster. And we could spend billions and trillions and still not catch up with what we need to do to put us on the same level as you see in some of these Asian countries that, George has been over there. We know what airports and transportation and roads ought to be like. And we don't have it. We have potholes everywhere. We have things falling apart, and we're just taking forever to rebuild. So I like the infrastructure investment area.
I have three subsectors here, which I think are going to they're performing pretty well. And technicals matter a lot to this market. You've got so much hot money out there in these high frequency prop shops, as well as everything's based on algorithms and all this technical, breakdown, breakout analysis. I still think that, the new industrials for America are the semiconductors, and, the whole host of the semiconductor equipment makers, the chip makers, the different fields that they have to address, whether it's autos, IoT, Internet of Things, 5G still out there. You've got all the AI business coming online. Just about everything we do with smartphones and all our smart homes and smart offices and all our clients, everything's got chips. So that sector is it's seen some volatility recently here, but you're starting to see a bid show up back again this week. I think that that's still the number one subsector in tech, despite the you've got 18 stocks that have basically carried the entire market all year long. Okay, 55% of the NASDAQ is made up of only 10 stocks, okay, of the QQQs of the NASDAQ 100. So this is a very top-heavy rally. But under the hood, the semiconductors tend to be, they do tremendously well usually during the fourth quarter. That's usually their strongest quarter. So I'd like to take a look at that. The SMH is your sector, but it has big holdings in Taiwan Semi. You've got some geopolitical risk there, maybe. But there's some great stories going on within. The the housing market, the XHB, which is it's got a nice chart. Today's Gallup poll came out and talked about how 8 out of 10 Americans think it's a lousy time to buy a home. Housing prices are still elevated, mortgages are up, and they're not feeling it, when it comes to going out and buying a new home. And so we still have a big supply problem here, and it's still going to be good for the home builders, because you see lumber prices are coming down, some of the raw materials are coming down, and even the cost of labor is starting to hold as opposed to going up every month. And so I think you're still going to see this secular home building trend. Today's new home building index came out, and builder sentiment was as high as it's been in 5 or 6 months. So their outlook is quite good. So take a look at that as a still an ongoing good theme from a standpoint of your old simple supply and demand problem out there.
Bryan, what about apartments? Don't you think apartment investing would be a better play?
Also, yes. There's a REIT out there which does a lot of that. It just does which I was looking at over the weekend here, and I think it's actually a REZ, which is it's the residential and multi asset REIT out there, and which means they're also doing public storage types, self-storage, as well as e-commerce warehousing. These are 3 big hot areas, especially when the job market's more in flux. You're not likely to take on a new home. You might be having to go mobile. And yeah, you're right, Mark. And then therefore the cost of maintenance and those types of things starts to plateau for these landlords. Certainly apartments are more insulated from and more defensive in nature. So that makes sense as well. And then lastly, at the expense of the tighter credit crunch at the banks that I'm seeing forthcoming here at the smaller regionals, for small and medium-sized businesses that have to get capital, the business development companies and corporations stand to really benefit from this trend. What are lemons at the bank is going to be lemonade at the BDCs, because they float stock to raise capital, and then they loan that out at 5-6 points above SOFR or LIBOR rates, which means they're generating 10 to 14% yields, dividend yields. And when you go back to 1926, when they started measuring the S&P 500, when it actually became the S&P 500 in 1957, the S&P's averaged about 10.1% per year since that time. Well, if you can capture that in the form of a dividend yield, and then maybe you get some cream on top with a little bit of capital appreciation, you're matching the S&P 500 historical, and you're getting cash flow. And I think for a lot of retirees and a lot of people out there, 10% cash flow is a lot more interesting than just hoping that the market goes higher by 10% by year end. So I'd say the BDCs, and there's 57 of them out there, and the three biggest ones are worth taking a hard look at. That's Ares and FSK, KKR Capital, and the third one is Apollo, I believe. So those are they're worth looking at. They're all paying about 10%. And it's just, in my Cash Machine newsletter, that's where I highlight 4 or 5 of these particular holdings, because it seems like now they're coming right into the sweet spot at the behest of the banking issue.
That's one of my main investments.
Main Street investment, huh?
Yeah. Main Street Capital. So let's talk about
10% though.
Yeah.
No, it doesn't.
So let's talk about the R word, recession. Are we going to fall into recession? Some people say we're already there, and doesn't really matter.
My gross output statistic is gross output continues to decline. I mean, it's growing, but at a very slow rate, as is GDP. So we're very close to a recession. And I think it's possible that we enter a recession in 2023.
Yeah, I think we actually have to go into recession, because that's the only way inflation is going to get down to the Fed's target. Incomes and corporate cash flow have to come down in order to bring demand for these goods and services down. So it's a little surprising that as much as the Fed tightened money in 2022, the economy is as strong as it is. And that's why inflation's been so persistent. So I think it's unlikely the Fed is going to get its inflation target without some level of recession. It's a question of how big of a recession is it going to be in order to bring inflation down.
Is there any chance of us actually getting down, or how long would it take? They want to get inflation down to 2%.
Right.
Ways to go. We got a ways to go. Is that a pipe dream?
Yeah, all those numbers are just, I'm sorry, but those numbers are just all absurd. What's really happening in the economy is an attack by the politicians on all our fabric of capitalism, and that is a real threat. And the inflation numbers you read are almost irrelevant. What matters is the entrepreneurial numbers. Where is creativity happening? Where are the new moonshots originating? Where is the future being nurtured? And we're in a global technological revolution, and which is being spearheaded by the move to the metaverse, by the Internet of Things, by Web 3.0, by a transformation of spearheaded by artificial intelligence. There have been historic breakthroughs in that field. which
Scary.
will create jobs. It's not scary. It's a lot less dramatic than the Industrial Revolution that I actually experienced, and AI revolution is just the next phase of computer science, and Silicon Valley, the sort of established companies in Silicon Valley, all imagine that they've reinvented the human mind when AI is really as dumb as a post. It's cockroaches all the way down. But we are in a world. There are a lot of opportunities out there, and to talk about gravitating to money market funds and all the existing established corporations at a time when a whole new economy is being born, I think is a distraction. Well, I mean, meanwhile, the politicians are really, we've gone full scale emergency Marxism in the United States. And so I'm for looking at companies all around the world. Moonshots, not existing vehicles of vessels of the cockroach population.
As far as recession, I see the country is really split right now. There are regions that are very strong, and there's regions that are weak. Some of the building, the vacancy, San Francisco downtown, I don't know if anyone's been there recently. It's a shell of what it used to be. But we're seeing very strong regions. Texas is slowing, but it's still very strong. And drilling's very strong here, is keeping a lot of people employed. But we're seeing this bifurcation in the country. Some places are in recession, others are not. That's why we get this real ragged economic data that seems uneven, and people look out the window and say, well, it's really not that bad. But in some places it is that bad. Others, it's not at all. And I think what we do from here, this is kind of, we got this sticky inflation, very 1970s like right now. The inflation is there. It's not going to go away. We got down to a level, but it's not going to go anywhere with things the way they are right now. And the Fed's in this hard position where I really believe the Fed needs a recession. It would like to create a recession, but it doesn't want a free fall that would cause, well, we saw what happened as soon as the fear ratcheted up regarding banks. They had to come in with their new facility because they were afraid things would just get out of control. But I think it wants to bring things down to get rid of inflation because of its mandate. And as I said earlier, the mandate isn't what we think it is. It's more of to protect the system that's in place now. And it's going to need a recession to beat that inflation to help bail out those that have these low interest investments that could really upend the financial aspect, the big financial sector. So I have this worry that the Fed is going to try to continue cutting money supply and generate a recession as its way to beat inflation. It doesn't have a whole lot of room to the upside with interest rates, so they can raise them. So it's going to have to get creative in how it brings us about. Sounds pretty far out there, but I thought about it a lot, looked at history, and I think the only way it can protect what it needs to protect, and that's not necessarily you and me, is to bring about a pretty steep recession to crush out some demand.
If that ends up being accurate, John, that will be very negative for stocks. You will not want to be long. You'll want to avoid being long any kind of high beta stuff, because right now the market, I mean, if you look at what's happened over the last 6 months or so, there's been buying in anticipation of a soft landing, which means no recession. Now, if you get a hard landing, that's I'll be speaking about that momentarily in my presentation next. But if that's the number one issue for the smart money, if you want to call it that, which I call it that because that's what actually drives returns, you're going to have an issue here if the hard landing and things come in hard, like you may be suggesting, John, which definitely could be the case, then optimism on this market is misplaced.
Yeah, that's a difficult one. I mean, because I'm big into market signals, and that's been the hardest thing, is trying to reconcile what's happening. I think George and Mark are getting kind of getting there as well, trying to reconcile what's going on with what we see in the economy versus what the market's showing. And ultimately, the market is the grand arbiter. It's gonna tell you the decision. And a lot of what I say, I could just be eating a bunch of crow, but that's the way it goes. You follow the market.
John, I do think we are still benefiting from the recovery from the lockdown, and that's one reason we haven't actually gone into recession. My geo statistic demonstrates that we still haven't gone into recession. And we have cities like San Francisco. That disaster is self-inflicted, as you know. There's no reason why San Francisco couldn't be booming right now if they would solve their woke crime problems that they have engaged in. It just demonstrates how poor management can destroy a great city.
And it can happen anywhere. I mean, Austin, Texas, in the great red state of Texas, police response times are non-existent. So you might as well be ready to take care of yourself there.
Just one quick point on San Francisco. Roger and I were in San Francisco not that long ago, and we had a good time, and the restaurants were booming and the events were booming. So I don't think all is lost for that city, but it's definitely not what it used to be.
Yeah, they still got the great restaurants, that's for sure.
Yes, we had some good dinners there. Well, we got just a couple minutes. So I just want to touch on real quick. George got into AI a little bit, and basically call it like the next step, and it's going to create jobs. Mark, you kind of shook your head there. There's a lot of debate out there. Is AI a good thing, a bad thing? What's it going to do? So we only got a couple minutes left, but let's I'd love to hear some of your guys' thoughts on that.
Let me just throw out some of the problems with AI, and one is that like George is saying, I mean, it's not like they are humans. Humans created this AI, but I can tell you as a professor, this is going to create a lot of lazy students, students who will rely on ChatGPT to write their papers. I've already had somebody do this before, and of course, I could see it right through it. I could tell right away it was phony baloney. But still, it is going to, it's just like students can't add and subtract anymore. They can't multiply and divide anymore because they have these computers. They have the calculators that do it for them, and this is becoming a problem.
Yeah. Well, people I knew how to milk cows before. The new generation can't milk cows either. I think artificial intelligence, teachers will have to teach, and they'll have to actually give live tests. A lot more performance and tests will be done in the classroom, and there'll be new ways to detect the problems of Chat GPT, spurious material. I think this is just another technology, and it's very pervasive. It will affect military, it'll affect industry, it'll affect schools. Schools need to be shaken up, Mark. We've pretty much abandoned education across most of our established universities. I went to my Harvard reunion, and all they talked about was climate change. Every department at Harvard has to have a special new theme of climate catastrophe. These are maniacs who've taken over the universities and corrupting the culture. And we got to go around the world to find new opportunities. And that's what I'm doing with my moonshots and all my newsletters.
I'll say one thing. I'm fond. My readers know that I'm fond of quoting lyrics. So, with respect to AI, I'm going to quote some lyrics from one of the greatest rock bands in the world, Rush. Said, "Big shots try to hold it back, fools try to wish it away."
Yeah.
That was talking about the nuclear situation, but it's the same thing with AI. I am optimistic on this. AI will be one of the greatest productivity tools in the history of the world, and it's not something to be feared. It's something to invest in. Okay, already my subscribers made 170% gain in like 30 days on calls of the company C3 AI. We're long NVIDIA. That's a backbone company in the AI space. Embrace the opportunity, like George says. Embrace the moonshots. This is a moonshot. You can make money on this. Don't fear the reaper, as it were.
All right.
And,
We're gonna,
for
we're
that
gonna,
matter,
we're gonna
also,
stay,
okay.
we could talk all day and we will be talking all day. We've got 7 presentations. And so I've got to wrap this up. Yeah, we could just have the 7 of us, the 7 of us on this call and just just talk all day and it would be, thrilling. But I've got to wrap it up. It's time for us to move on. But I just want to, thank the guys for being on this panel. Thank you. You'll be seeing everybody throughout the day. I truly, guys, I'm literally just honored that I get to work with you every single day and that I'm your publisher. That really means the world to me. These guys are just, top notch and some of the best in the industry. So I'm just very, very honored. 20 years I've been working with Mark and 20 years of doing this. It's really just, I'm so blessed. But moving on, I want to remind
Let's all
everybody.
get together at Freedom Fest.
All
Nobody's
right. Yes. So remind everybody to subscribe to our YouTube channel. We have great events like this. We have new content every week, and we actually have a few more things we're thinking about where we're going to have a lot more information. So make sure you hit the subscribe button right below this video to subscribe to our Eagle Investing Network, and you won't miss any of the great events. And up next, Jim, you and I will be right back in just a couple of minutes. And again, it's a great kickoff to today, and we'll see everybody in just a couple more minutes.
All right. Thank you.
Adios.
Take care.
Thank you, guys.
Great job.
Well, welcome back, everybody. What a way to kick off our live event here on YouTube with that outstanding panel. I hope you enjoyed it as much as I did. It's always a great conversation when we get together. I'm so blessed to be able to work with these guys every single day. And in addition to these YouTube, live YouTube, sessions that we do, we have content that comes out every single week. Lots of great free content. So be sure not to miss any of it by hitting that subscribe button right below the video right here. And you'll, don't miss anything. So up next, as you can see, we have Jim Woods is back to kick us off on our individual presentation. So Jim, how's it going today?
They're going great. It was an excellent discussion. I feel very extremely privileged to be able to talk to these guys, my colleagues, my brilliant colleagues, and yourself. I can pick all your brains whenever I want. So I consider myself quite the fortunate person, right? In this,
Yeah,
in this
well, we
space.
love picking your brain too. We
Thank
we have a fantastic team. So I'll turn it over to you. Go ahead and share your screen and
Okay,
we'll get
sure.
going.
All right. So, well, let's talk about what we're going to talk about today. And today is, excuse me, a little bit front there. I'm getting too excited. Hitting the buttons too fast. It happens. So, as Roger mentioned, I am the editor of the publication that we're going to be talking about today called Intelligence Report. And you're going to find all about Intelligence Report, the different portfolios we have, the different strategies we have, and I'm actually going to show you some sample pages of the newsletter. And at the end, I'm going to tell you how you can become a member of Intelligence Report at the absolute best price I've ever seen for this product. So today I'm going to start by telling you something. I borrowed this line from the great Francis Bacon. Now, Francis Bacon, if you don't know, was a brilliant scientist. He was actually a statesman more than a scientist, but he actually was a philosopher of science, and he was one of the first people to kind of think of the world as a rules-based entity. And his famous maxim in his famous work Novum Organum was, nature to be commanded must be obeyed. Okay? So, being that we're talking about markets today, and markets is our field of interest, my spin on this is markets to be commanded must be obeyed. And that's what we're going to do. We're going to command markets by obeying the rules of markets and by understanding their nature and their principles. And by doing so, I'll show you how we best the S&P and how we have last year, and how we're planning on doing that again this year. Okay. To be commanded means to be made to serve man's purposes. Must be obeyed means we must discover the principles of smart investing and use them accordingly. Once again, my name is Jim Woods. Intelligence Report is the publication we're talking about today, but I also helm the Successful Investing newsletter. I also have High Velocity Options trading service. I have the Bullseye Stock Trader trading service. And then I have a morning briefing publication called Eagle Eye Opener. It's every trading day, you get everything you need to know about the markets in a less than 10-minute read. And then my free e-letter is called The Deep Woods, where we talk about markets there. Sometimes we also talk about social issues and issues of philosophy, capitalism, politics, art, whatever I think is interesting to you. That's what we're going to talk about. So that's our fun publication. And then I have a publication called Fast Money Alert that I co-edit with Dr. Skousen, and the two of us team together to buy stocks and call options. And then finally, I have a podcast called The Way of the Renaissance Man. And all this information can be found out at jimwoodsinvesting.com. So that's your go-to source. Go there for any further information about any of the publications that we have, and sign up for the Deep Woods if you aren't already a member of Deep Woods. Okay, now this is a photograph or a piece of art that I like. And somebody actually asked me at a recent money show if that was an actual photo of me studying the markets. And it actually is a photo of me studying the markets. Roger can verify that. So it's always nice to get a little humor in on your presentation.
Who asked that, right?
Yes, there you go. Who asked that, right?
Bad joke, sorry, bad dad joke.
You had to do it.
I'm a dad, you know, what can I say?
Exactly. We do have a picture of Roger studying the markets like this, but he's not going to reveal what it looks like. So maybe one day he will. Okay, so but actually this drawing does bring apart, it does kind of exemplify my approach to things, because in all seriousness, if you want to command markets, you have to obey the rules, you have to obey the data. Okay? And there's no more appropriate meme than a wise owl looking at the data with a candle burning. And that is definitely what I do on a daily basis. And I do it in the services of our publications, because there's a lot to get your arms around when it comes to the information. It never stops. It's always flowing at us. And the key is to be able to see with the right pair of glasses and to know exactly what matters most. And in a little bit, I'm going to show you some of the things that I think matter most in the second half. So it's actually an appropriate little meme to go on for. Okay, so let's look at something before we get into the details of what I think is going to happen in the second half. Let's look at the details of what's happened in the latest kind of big runs in markets, the big trends in markets. Now, this is a chart here of the domestic averages, S&P, Dow, NASDAQ, and Russell 2000. And I call it the bulls loving to run. Okay, this happened on March 20th, 2020. That was the beginning of this huge bull run. And it went all the way to January 3rd of 2022. Okay. So look at the numbers here. Look at some of these tremendous gains that we saw. And of course, keep in mind, this is during the heart of the COVID pandemic. Now, on March 20th, if some of you will remember, that was the day basically that the Fed came in and slashed rates and opened up monetary policy like in response to the COVID situation. And there was also a lot of fiscal stimulus that was about to come out as well. But the Fed was the key for markets, because the Fed took rates, cut them, slashed them to rock bottom, and the markets responded by soaring. And this was in the middle of the worst global pandemic in 100 years. So we saw huge gains, 124% gain in the Russell 2000 and 130% gain in the NASDAQ over that time period. Now, hopefully you had the wisdom to be in markets at that time. But the problem was a lot of people didn't. A lot of people were really scared. The end of 2020, middle 2020, people were losing their jobs, losing everything because of the shutdowns. But if you had the intrepid nature enough to go into the market at this time, like we did in Intelligence Report, we stayed in the market, fully invested, didn't go to cash or anything like that, this would have borne out with tremendous results. So keep that in mind. When you feel the biggest amount, when you feel fear in markets, usually that's a turning point to go around.
As they say, buy when there's blood in the streets. That's the
or at least don't sell. You know, especially when the market was, it was a huge temptation, because leading up to that March 20th, the market did crash. But it went right back as soon as the Fed stepped in. And if you knew that was going to be the Fed's response, and if you knew how markets respond to the Fed generally, you knew that was going to create a positive bullish condition. I didn't think it would be that positive, but it goes to show you that the bulls love to run. Now, of course, conversely, the bears love to growl. Now we saw that last year. It was a horrible year for markets. Not coincidentally, that was when the Fed started hiking rates again. You know? The Fed has been on a hiking trend for, I think, 500 basis points now since they began the latest hiking situation. Now, the problem, of course, is, or the good thing is they're probably almost done, if not being done. We'll talk about that in a moment. But the fact that they're basically done could tell you that we're in for a potential rebound in stocks. We've already seen that a little bit in the beginning of 2023, especially in tech stocks, large cap tech stocks, which is some of the areas that we're in the market in intelligence part, especially tactically. But you want to know these kind of things. You want to know that the major domestic averages were down big last year, as you can see by the chart here, almost 30 or over 33% in the NASDAQ composite. Now, since then, we've seen a huge rebound. And part of the reason why is because the market is betting that the Fed is going to stop and that the Fed eventually, even late, maybe perhaps later this year, will actually start to cut rates again. So the market's anticipating that potential. Now, whether that happens or not depends on the data, and that depends on a lot of other things like the bank situation is a wild card that came out that we haven't seen. But like the COVID thing, that's a wild card that you have to factor into markets. And that's part of knowing how to command markets, by obeying the data, obeying the way things unfold, so that you can position your money for the properly to take advantage of it. Okay. So what's in store for the second half of 2023? That's today's theme, and we're going to be hearing more about that. You already heard a little bit about that in our panel, but you're going to be hearing more about that from my colleagues. Let's take a kind of an overview look at that right now, because it's important to know where we think things are going to go and what factors need to fall in place in order for those things to come about. So here are some of the biggest factors I see as influencing markets for the rest of the year. Will we have a hard or soft landing economically? In other words, will the recession just kind of come about and smack us and cause economic discontent and earnings recession and a recession in consumer spending and growth, job losses, things like that? We're going to see a hard landing, or is the Fed's action going to result in what we call a soft landing, meaning there is no recession, there might be some healthy reduction in inflation, maybe a little bit of slowing in terms of economic activity, but there'll be a jobs pullback that's manageable. That's what we hope to have happen as a soft landing. Regional bank stress is a second one. Now, we all know about FRC and SVB and some of the other issues that are plaguing some of the other banks out there, especially the regional banks. So will we see more regional bank weakness? Will we see more defaults? The JP Morgan CEO Jamie Dimon doesn't think we're going to see that, but he's also in a position to benefit from some of these banks falling apart by scooping up some of their assets, like he did at First Republic. But that'll be the question: will we see more bank stress? If we do see more bank stress, that could have ramifications. If the banking stress is over, then that's another situation that we want to look at. And I'm going to show you a table here in a minute that games out all of these scenarios. Inflation. Is inflation going to finally ameliorate? Last week, we saw inflation numbers in the CPI. We saw the headline number come in slightly lower than expected at about 4.9%. That was just the headline number. The more important core number, which excludes the volatile food and energy, that came in at 5.5%. And that is basically where the kind of on the upper end of the just okay, not as good as expected kind of metric that we want to see. And the result, of course, was the market had a tepid response that day. And, no one was excited about that inflation number. No one was really distraught about it either. It wasn't a huge spike in inflation. But what we would have liked to have seen is the core inflation rate go down a little bit more, but it didn't. So we have to wait for more inflation data going forward. Now the Fed policy is the second one. Now, are they going to follow what I call the Fed script? Okay, Fed script is that started earlier this year was hike, pause. Hopefully, we're at that pause stage now, although that remains to be seen. Pivot, meaning the Fed will do a turn in terms of its stance on monetary policy, and then finally will it cut. So right now we're in the pause / pivot phase, and I suspect that the Fed has paused. They've signaled that to us quite a bit with the most recent rate hike, but we don't know because many people thought the Fed would be done a couple of months ago, and it wasn't, so they kept on hiking. So if the data keeps coming in hot, then the Fed will possibly hike again. If the data is softer, the data shows that what they've been doing so far is actually starting to work and slowing down the economy properly, then perhaps the next step would be a cut. Now, the futures markets, the last time I checked, was pricing in a cut like somewhere as soon as July, but definitely by the end of the year. So the money seems to think that the Fed is going to cut. Now, if they do or not, that's something we won't know until they actually do it. But money will start positioning itself into riskier assets if there is a potential Fed cut. And that's something we need to know, because that is why tech stocks have done much better over the last several months than stocks or situations like energy or utilities, or some of the ones that did really well in 2022. So the market is always changing. It's always flowing. So you need to command the market. You have to obey the data. And then finally, there's a debt ceiling, which last week there was some initial talks on the debt ceiling, but if we don't get any conclusion to the debt ceiling, then that's definitely gonna cause some dysfunction in the markets, because no one wants to see that happen from a market standpoint. Okay, this is the kind of data table that I put in the Eagle Eye Opener, but also we use this kind of information in the Intelligence Report newsletter, because it gives you a quick kind of assessment of where we are now, what will happen, what will need to happen for things to get better, and what will need to happen for things to get worse. So the first thing, hard landing versus soft landing. So right now, in April, economic data showed moderation, but not a collapse. If things will get better if the data remains mostly stable and implies that soft landing, but things will get worse if the data deteriorates, and that implies a hard landing, and that the Fed paused just a bit too late. Now, my assessment is the Fed always acts a little too late, either on the cutting side or on the stopping and the change in monetary policy. They always pivot a little later than they can, and it's not really their Fed's fault in that sense. It's just it's hard to understand. You can't really turn a big ship like the U.S. economy on a dime, and because they're forced to try to do that, which they probably shouldn't be from a larger macro perspective. That's a discussion for another story. But whether the fact is, we have a Fed, and they do have influence on this. Now, most of us, I think, would like there not to be a Fed and not to be this kind of situation, but we must deal with the facts as they are, because remember, markets to be commanded must be obeyed. So, wishing won't make it so. So regional bank stress, I mentioned that. If we see right now, we've seen vulnerable regional banks, and there continues to be a slew of those. But if no more banks fall and the crisis generally recedes, then that'll be good for markets. If things get worse, like we see more failures, then of course that will increase what we call contagion fears, and that will be a negative for markets. That will keep things down. Now, conversely, the worse the bank situation gets, the more the Fed will likely pivot. So from a market standpoint, it's not good, but from a Fed standpoint, if we want to pivot, that could be good, actually, because the Fed is going to respond to that. They're not going to keep hiking rates in the middle of a banking crisis. Now, here's the next thing is inflation. Right now, I mentioned the headline CPI most recently. That does remain sticky, although it's improving, but the core inflation has not really fallen. And now we want core inflation to fall below 5%. It's about 5.5% now. So that is not something that's going to be stimulative for the bulls, but it's at least we're seeing the movement in the right direction. But for things to get worse, we would need to see the core inflation continue to be where it's at, or if it gets higher, if it goes up, that will really disrupt the apple cart, because that will mean that the Fed's not really being effective at all on the inflation front. So Fed policy expectations, it goes hand in hand here. The Fed has likely paused with rate hikes, but markets now will be looking for clues as to when they might cut rates. And I mentioned earlier that the July futures are basically saying that there could be a cut as early as then. So that's only a couple months from now. So I don't think the Fed's going to cut rates in July, but they could at the end of the year. The Fed officially confirms that rate hikes are done. This will be the scenario if things get better, and if they begin to offer a little bit more concrete hints that they're going to pivot in a dovish fashion, which just means they're done hiking. And things will get worse if the Fed puts a 25 basis point hike back on the table. That would undermine that hike, pause, pivot, cut script that I talked about earlier. And we don't want to see that, because the market right now is currently pricing in that result. Debt ceiling, there's a wrangling right now. It's positioning going on. If things will get better, if the debt ceiling gets extended, or if they, have like a more permanent solution to it, I doubt that's going to happen given the political climate. But at least they can put a patch on it, and that'll kind of put things off to later. No debt ceiling deal, and we start to default on obligations in early June will cause a major disruption in markets. So that's one of the wild cards.
Seems like they always just put a patch on it, as you just said.
Yeah, I mean, that's a great point, Roger. I mean, the thing is, like, why even have a debt ceiling if you're just going to raise it every, few years and just kind of go through this rigmarole of trying to go to the brink? I mean, they're going to raise it because we can't default on our obligations, because that would cause more pain and suffering. So it's one of those problems where you create a problem for yourself, and then if you try to fix the problem with the medicine that really should be implemented, you're going to kill the organism. So we're in a bad situation, and no surprise that it's politicians that got us there. It's certainly not normal investors like us or people trying to make sense of this market. But again, we have what we have, and we have to deal with it. So that's the way things are. That's the way we have to. That's the nature of markets, and then to be commanded, we have to obey those markets. So just a few quick things here to wrap this slide up. Expected 2023 S&P 500 earnings per share. Then this is the estimate that analysts have given. 225 is the earnings per share kind of estimate on the EPS on the S&P 500 right now. But if things get better, that could move up to 240. And if things get worse, it could go down to 215. Now, if you look at the different multiples that are out there right now, 17 to 18, 17 and a half, 18 and a half, 15 to 16, you can see that if you do the math out, that the change from today, if everything goes as expected, would be a slight decline in the S&P in terms of the midpoint of about 4.8%, about 5% almost. Now, if things get better, we're looking at about a 4.5% upside from here. But here's the key number to really be, respectful of and to worry about. If things get worse, and all those things in that right column of things getting worse, if they all get worse, then we're looking at a 15 to 16 multiple on 215 earnings per share. That would take the S&P 500 down to about 3,300, and that's about 19% lower than where we're at right now. So that is a big concern. Now, I don't think that scenario is going to play out. I'm sure there would be some things that might play out on it and some things that won't. But this is the worst case scenario if everything goes badly. That's the kind of downside we could be looking at. However, I do not think that's going to happen. I think the more likely scenario is the current situation, maybe a little bit of improvement on some areas, but a little bit of decline on other areas. So that's one reason why I update this panel every month, just to see where we're at. And this is the kind of analysis that you'll find in the Intelligence Report newsletter. Okay. Here is the approach that we employ with the newsletter, because like any good plan, you have to have certain principles that guide you. So here we employ what I call a disciplined approach, meaning we're not chasing rabbits, we're not running scared, we're not trying to react to every little thing. We know what's going on in markets. We've done the analysis, but then we want to approach it in a disciplined and strategic fashion. We buy stocks for the long term, particularly in our long-term dividend-oriented portfolio. And we diversify those holdings among key segments in the market. Last year, energy was the top performing sector, and so we had our energy positions really did well and helped carry our portfolio for the majority of the year, while other sectors were down. But this year, we're seeing information technology and communication services and just general tech outperform. And our allocations to those areas have helped us outperform. So we want to diversify among the key segments in the market. So we're not, all our eggs aren't just in one tech basket or in one energy basket, whichever happens to be hot. Because when you play that game, you're always going to be chasing, you're always going to be following, it's going to be kind of like behind the curve a little bit. So we don't want to do that with our long-term capital. We also want stocks with track records of hiking dividends. Now, then we also want to get tactical with our short and medium-term money. So we want our long-term money to be working for us, and we want to stay disciplined there. But with our tactical short and medium term, we want to make sure we take advantage of the outsized conditions in the market that are driving a certain sector or a certain company or a certain exchange traded fund higher, and that we want to use that to gain alpha. So we want to be in the best stocks, but we also, with some of our money, we want to be in the areas that are outperforming the rest of the market, because that allows you to kind of add a little bit more alpha. And if you're strategic and smart about it, you can do just that. I'll show you how we've done that last year. Okay, so here are the three portfolios that we have this is what we call them in the service. Now, the long-term dividend-oriented paying positions are in what I call the income multipliers. These are 20 stocks that we own that are spread out throughout the market. And these are the companies that have paid dividends for the last 20, 30, 40, 50 years, even in some cases. So this is what I call the best of breed stocks out there. Companies that you all have heard of, that you use their products, or that they're used in industrial things that you've been to, like companies that build, like make equipment that build other things. And then we have a tactical trends portfolio. It's called, for short, I call it the TTP. That's a fundamental technical and what I call news queue based portfolio, where we trade positions short and medium term, although it's not an active day trading service or a weekly trading service. We like to hold positions for several months in there, and sometimes we've held them longer. And then finally, we have a protection portfolio. This is designed to, if you're in a situation where you're already retired and you want to just make sure nothing bad happens to that money, because you want to you want to preserve it for generations to come, I'll show you how we do that. Okay, let's go first into the income multipliers here. And here's kind of the general rundown of it. I select 20 best of breed stocks that are dividend oriented. These stocks are curated from a selection of 12 different sectors. So consumer discretionary, consumer staples, technology, information technology, energy, utilities, and then some special situation things, amongst others. Basically your S&P 500 sectors. The diversification there takes us through the different market swings and the different rotation, natural rotation of money from one sector to the other. So we always have some exposure to the winners. We always have, and conversely, you're gonna have some exposure to areas that aren't performing, but that just allows you to get in more and kind of buy into those at a cheaper price, an average down kind of thing strategy. Because with the income multipliers, you always want to be adding money to this list of 20 stocks. The key here, of course, is the discipline, the patience, and of course, the power of compounding over time. That is going to lend you the best results. So this is for your series. This is like a personal 401k for you. So to give you an idea of the performance here in very, very tough 2022, our total return on the income multipliers was a minus 2.58%. Now, that isn't exactly the wildest performance in the world, but it is when you consider that the S&P 500 had a total return of negative 18.11%. So we trounced the performance of the S&P 500 last year. And it's because we had exposure to all the market areas, but we had exposure to areas that did well and exposure to the entire market. And that diversification allowed us to escape a double-digit decline. If you would have just had an S&P 500 fund, if you do have that, you don't need me to tell you that 2022 was a horrible year. But if you had intelligence support and money in the income multipliers, you would have lost a minimal amount. And you'd be
diversified in the right places.
Diversified in the right places. Yeah. A lot of people think diversification means I got 60% stocks and 40% bonds, or 40% stocks and 60% bonds. No, I'm talking about diversification within the market and the proper stocks, the best of breed stocks. That's the key. Okay, let's look at the tactical trends portfolio. Now, this is the medium term, short to medium term position. We're not holding stocks here for 5 years. We're holding stocks for 5 months, maybe up to a year sometimes, but we may only hold something for 5 weeks. Depends on the market. We select stocks and sector ETFs. Okay. We use a combination of fundamental, technical, and what I call news Q factors. So fundamentals like earnings per share growth, technicals like chart patterns and relative price strength, and then news Q like what's happening in a specific industry, where's the smart money going, what is the likelihood of that company being driven by exterior factors or internal factors even that will propel it higher. Now, some of the samples here, Apple, of course, is one of our holdings, and that Apple was a top performer because during the pandemic, people bought technology, and now that the market's coming back in technology, Apple's done extremely well. So for 2022, wasn't that good, but we weren't in it then. So the stock that did really well for us is Tesla. Tesla was, of course, that's the whole Tesla story has been well documented. Most likely you all know about it. It's most innovative car company. They've had certain periods where they've struggled, but then they've also had periods where the stock just goes through the roof. And because people want to invest with a brilliant mind, they want to invest in a sector that is game changing, like electric cars. So that's what we did. PDBC is a commodities ETF. That was one of our best winners there. We had over 100% gain in that. And we bought it at the right time, and we sold it at the right time because at that point, commodity inflation was big. So we took advantage of the news queue of the day and bought that. And then we also have pharmaceutical stocks. PPH is an ETF that exposes us to that area. And that area was very hot for a long time. So we had that, we put it in there, and we owned it. So just to give you a taste of what we did last year, total return on this portfolio was 11.26%, a gain of 11.26%. Once again, if you had just an S&P 500 fund, you were down 18%. So that'll give you an idea of the kind of short-term alpha and
Perfect.
how things perform. Yeah. Roger likes that one.
Absolutely. So does your subscribers, and we
Yes,
have
exactly.
about 5 minutes left, Jim.
Okay, all right. I need to rush through. I'm sorry about that. Protection portfolio. Okay, to protect and to serve, we use short and intermediate term bond funds for this. We use consumer staples ETFs, dividend growth ETFs, and gold. So that kind of combination is not going to net you huge gains over the years, but it will protect your money. And in 2022, the worst year, in many years, we had a negative 1.31% return versus again that 18.11% in the S&P. So once again, the money was preserved through all of that craziness of 2022. Now that's the kind of positioning you want when you're trying to protect your money.
Yeah, and you think about
Right,
not only was the S&P down 18%, but bonds had their worst year since 1982 or something like that.
Yeah, that's exactly right, Roger. And that's one of the things that we use in the protection portfolio. We do have bonds in there, but we have the short and intermediate term bonds, so we're not exposed to the long end of the curve there. And that was those were the best performing bonds in that space. So I mean, if we would have had zero bonds in there, it might have even been better. But you don't want to just move in and out of those kind of long-term protection.
It did its job.
It
did its job.
It did its job. Exactly. It did its job. It helped preserve our wealth. And that's what those positions are for. Okay, so here's what I call the cheat sheet, meaning this is the slide you want to take a picture of if you just want a recap of the service. A disciplined approach, best of breed dividend paying stocks, diversification through the market swings, get tactical with their tactical TTP holdings, protect and serve with the protection portfolio. And every month you get a 10-page newsletter along with a couple of pages of economic analysis. You get market intelligence and analysis of the sort that I showed you earlier. You get portfolio updates every month and every week. We have a weekly hotline that updates portfolios and also tells you what the action was in the previous week and what to look for in the next week. Here's a few sample pages of the newsletter. As you can see, we started off this is the front page here on the left. This is I talked about recency bias and what I call the gamblers, or what's known as the gambler's fallacy. People think that that just because we've seen everything come up black, 5 spins in a row, that the next one's got to be red, but that's not the case. There's a 50-50 chance just about on every spin. It's different. Mm-hmm. So don't be seduced by the gambler's fallacy or recency bias, because what happened recently doesn't mean that's going to happen next. So that's the kind of analysis that we talk about. And then here on the right side is the income multipliers update. Here's some of I put 3-year charts in there so you can see all the machinations of the different companies we have. This is just a sample of 5 of them that we own, but you get glimpses on all 20 as the market dictates. Then we also have a lot of data that shows different charts like that will allow us to get that kind of intelligence that we want. For example, we have the bond market, we have gold, S&P 500, the US dollar, oil, and then international stocks. So every month you get an updated chart of that and where we are, where things have been, along with the analysis to make sense of it. And then we also have the page that I actually quite like a lot. It's called What's Up and What's Down. I have all of the different market years for all the different subsectors, not just from this year to date, but going all the way back to 2008. So you can see how things performed, where we're at, where we've been. Because if you want real historical context, you need to look back at the markets since that time. And when you do that, you realize that everything old is new again, and the more things change, the more they stay the same. As to borrow a few pearls of wisdom. Okay, just one thing here as we almost conclude. This is something that I like to show because there's an independent firm called TipRanks that ranks all of these newsletter writers like myself, and they recently ranked me as the #1 blogger out there with a 73% success rate and 16.6% average return, and that's out of over 7,000. So now these are measuring my performance throughout different newsletters, not just the intelligence report, but I mentioned I have a lot of different trading services. So it just gives you a sense of how the rest of the playing field is performing and where I stand in respect to that. And sometimes I'm #1, sometimes I'm in the top 10, sometimes it depends on what given month, but I'm usually near the top, and I'm very proud of that, and I plan to continue doing that for everyone. Okay, this perhaps is the most important slide of the day, and I know it is. Roger tells me it's the most important slide of all of these presentations. I have to get this one right, everyone. So for those who may not know, Eagle has been a company for 20 years. We're just hitting our 20-year anniversary. And Roger, I believe I've been there for almost all of those years, haven't I?
Almost. We started
Yeah.
with just forecasting strategies, and then we added the Doug Fabian line, which you took over
Right.
a year or two after that. So
Yeah, I think it's been since about 2004 or 2005, which will put me up almost 19 years now, I think.
yeah, we started in
So 2000,
2003,
yeah.
obviously. So yeah, 18
It
years.
doesn't seem like that long.
We
It seems like
were five. We were
we just
five,
met for
right?
a drink. But yeah, that's what happens. You blink and your life flies by. But it's been a pleasure. I've just as a side note, thank you very much. But this is the important thing. Intelligence report, our special investing 20-year anniversary offer. Regularly, we sell the publication for $249 a year, but we're offering a near 70% discount today for our YouTube viewers. The special introductory offer is $20 per quarter. Now, obviously $80 or so per year, but it's billed quarterly if I'm not
Yep,
wrong.
it's $20 per quarter, and every quarter it's not going to go up. It's $20 per quarter, and that's
it. Okay. Then all right, then it's not even then you're gonna lock in for the lifetime of the publication. You're gonna lock in the best price I've ever seen for this publication. So I invite all of you to do so. If you like what you saw here, you like what we said earlier in the panel, give Intelligence Report a try. You'll get access to all those aforementioned benefits, the income multipliers portfolio, the tactical trends, and the protection portfolio, and the analysis that you need to really command the markets and make sense of them, and to outperform. And that's what we all want to do. We all want to be smarter than the market. So by doing though, we need to know what we're dealing with so we can actually do just that. And, we need to know, we need to command the market, so we need to obey the information. And that is what I think the intelligence report can do for you. And I'm very excited to have everyone come and join me in this journey. And I hope you all come along, and thank you very much for tuning in today to me and for the rest of the presentations today.
Yeah, well, thank you, Jim. And to take advantage of that $20 per quarter offer, again, we're going to be having 20th anniversary specials all day today. So this is the first one, $20 per quarter. All you have to do is click the link in the comments section right to the right on the screen there, and that'll take you to a specific order page. You go to our website, you're not going to find this offer. This is a special offer for the YouTube special event today in our 20-year anniversary. So thank you so much, Jim, for spending time with all of us today. And click on that link to subscribe to Intelligence Report right now. And we'll be back with Mark Skousen in just a couple of minutes. I'll see you in a few. Welcome back, everybody. I hope you enjoyed Jim Woods' session. And I want to remind everybody we have a lot of great content on this YouTube channel, and you don't want to miss any of it. So hit the subscribe button right below this video, and that way you'll be on top of it. We have lots of free information. Every week something new gets posted. And of course, we do these live events and several other things as well. So up next, as you can see, we have Mark Skousen. Mark there with his hat and his totem pole behind him.
Yes, the Adam Smith is at the top, and I'm wearing an Adam Smith tie because it's the 300th anniversary of the founder of free market capitalism, and that's what we're all about, aren't we, Roger, in Eagle Publishing, and trying to help people get rich in a world of a lot of uncertainty. So it's a pleasure to be here today.
Yep, and it's great. We we really do have, of course, I'm biased, some of the greatest investors in the world, and I'm very picky on who we get, and that's what it's all about. It's all about helping people. That's why we do the live event today. That's why we have the YouTube channel and all sorts of other things. So, all right, let me share the screen here, and we should be getting ready to. All right, so there we go. So, Mark, take it away.
Well, thank you, Roger. It's a pleasure. I have, in addition to my newsletter, Forecasts and Strategies, which is in its 43rd year, I'm really pleased with the performance. I would like to think that I've been a survivor, if you will, and it's a very tough business, as you know, on Wall Street, to give people advice, sound advice over time. And I've gotten lots of letters over the years of people very pleased with the trading services as well as my newsletter. So I now can say I'm a veteran in this business, and I still plan to be around here a long time. So I'm the editor of Forecasts and Strategies, F&S, and I also have several trading services. And my favorite, of course, is the 5-Star Trader, because it really helps you as an investor to focus on what really works. And we choose 4 or 5 different criteria, 5 criteria actually, to really reduce the number of stock selections. And we've been very successful in this service. I think, Roger, it's been going now for maybe 10 years. I don't know, a long time.
Yeah, I don't remember, but I know in the slides we have the date that it started, but I don't recall it right off the top of my head.
Yeah. So just in terms of background, I've been traveling the world. My wife and I have lived in many parts of the world. We've been to 77 countries, lived in 6. And I'm an applied economist. So I take my PhD in economics and apply it in business, in finance, and economic policy. Steve Forbes awarded me the Triple Crown in economics for my work in theory and history and education. I have had experience in the government, working for the CIA. I've been running many for-profit companies. I even ran a nonprofit for a while. So I've been in all the major sectors of the economy, and I think that really has helped my approach to how to make money in this very tough business. I also produce a conference every year called Freedom Fest, and this has been a great event over the years in Las Vegas and other parts of the country. We're in Memphis this next July, so it's really been a great experience. And we have an investment conference at Freedom Fest, so I probably have the Guinness Book of World Records in terms of attending and speaking at various investment conferences since the mid 1970s. So that's a long time with the money shows and with the New Orleans conference and my own conferences. So it's really been a great experience meeting up with investors like yourself, and just being aware of what is going on in the world. It's not just about time, it's about timing. And that's why we have our trading services. So I've also written a lot of books in applied economics and finance and in business. So it's really been a pleasure. And I've taught at Columbia Business School, some of the top schools in the country, now teaching at Chapman University. And just last year, I was appointed the first Doty Spogley Endowed Chair of Free Enterprise at Chapman University. So adjunct does good. So let's talk about some of the mistakes that investors make. I've listed here 3 mistakes that investors are famous for making. I've written a book called The Maxims of Wall Street, and many of these mistakes are highlighted in the book. And of course, one of them is this is extremely difficult thing to figure out when to get in and out of markets. And of course, most investors tend to jump in finally when the market is already moved substantially higher, and may even make the mistake of buying at the top. And then the market is tanking, and finally people get frustrated and they end up selling, and they end up selling at the bottom. So those are actually 2 mistakes in one, if you will. So you don't want to be able to guess. You want to have, my strategy is to stick with fundamentally sound companies. And when the stocks are down, that's a good buying opportunity. So instead of selling, you're actually buying. So that's one of my approaches. Another mistake is that you really don't understand the company you're investing in. You just see that the price is going up and you jump on board, but do you really know what's going on? I remember an investment advisor who was famous for ignoring the fundamentals of a company completely and just looking at the stock symbol and the stock price, and didn't even know what the company was involved in. I think that's a big mistake. If you look at Warren Buffett, if you look at Peter Lynch, John Templeton, all of the great Peter Lynch, all of the great investors and veterans in this business, they know that the more you know about an investment, the better off you are. And I make a point of knowing not just the technicals of where the price is and volume and so on, but what is going on in the company and what is the news? What is the latest news? And all of those affect the marketplace. So that's mistake number 2. And finally, mistake number 3 is cash is safe. Now, I have to put a little asterisk to this because finally, for a long period of time, for at least 10 years, we weren't making any money on cash, and you were losing value every year because the interest on money market funds was nil, and on CDs was practically zero because of the Fed's easy money policies. And but remember that if you go to a cash position, that cash is going to burn a hole in your pocket because you're going to be anxious to jump on board and get something involved in some investments that make money. But right now, with 5% on some of it, we actually do have a cash position. Myself and a lot of investors do, but I use that cash as an investment opportunity. In other words, I want to have cash available to jump in a market, which is can suddenly turn around and start moving sharply. And that's one of the reasons I started the 5-star trader, because the 5-star trader identifies what stocks are about to take off because of the criteria that we select. And it's been my most successful trading service. So with that, why don't we get into the 5 pillars of the 5-star trader and look at what we're trying to accomplish here with this trading service. Now, understand that this is a trading service. It's a short-term trading service. So we want to look at 5 criteria that are extremely important to select which of the thousands of stocks out there, and we can reduce the number of stocks to 50 or less out of the 3,000 or 4,000 stocks that are trading. So our first criteria is we want to have growing sales. We want a company that is expanding its business. It's in a sector of the economy that's growing. So growing sales is our number 1 criteria. Second, we don't want to just pick something that has growing sales. There's lots of companies that have growing sales, but we also want to be profitable. It's really important to have a profitable company, because if a company is profitable, they are going to have the means to keep growing and expanding and acquiring new companies and new customers and so forth. And they can even start paying a dividend. So healthy profit margins are extremely important. Finally, if we can find a company that's growing, that has healthy profits, but is also selling at a cheap price, that's really a key point. In other words, you can jump on board a company that has growing sales profitability, but what if the stock is selling for 70 times earnings or 200 times earnings, which can often be the case because investors are excessively bullish, the irrational exuberance, if you will. This is a real problem in the marketplace. So we're going to look for overlooked companies that are starting to grow, starting to have higher profit margins, but the investors really haven't discovered these companies. So they have a cheap PE ratio. In other words, it's selling for small multiples of earnings, and that suggests a bargain. Now, that's pretty rare. You can see these 3 criteria. We're reducing smaller and smaller number of stocks that qualify for these 3 criteria. And we're going to narrow down now to another one. We want to not only have healthy profits, but we want to have earnings growth. So again, what are the chances that you can find companies with growing sales, growing profits, and earnings growth, and still is relatively cheap? It's pretty rare. So now we're getting down to very few stocks that fit in this category. And the final thing is we want to have, as a background, companies where major institutions are investing. So I do check out that criteria as well. So we have these 5 criteria, and this gives you something that's a little more detailed to show you specifically what we use. What we do is we run through our computer software program these 5 criteria, and out pops 50 some companies out of the 3,000 or 4,000 that are trading. So you can see it's a pretty rare situation. You need a computer software program to do that. And that's what our 5-star screening process does. We do this like once every month or 2 months to find out because what stocks fit in this category based on changes in their earnings reports that come out every quarter and so on. So you can see, so what we want is sales growth over 11%, double digit. We want profit margins over 12%. We want, I'm going to stick to and go down to the 4th one. We want earnings growth over 23%. So not only are we have high profit margins, but they're also growing over the last couple of quarters, earnings growth of over 23%. And then we want major institutional buying. We want to have hedge funds, private equity firms, banks, insurance companies, various institutions who are big buyers and long-term holders of these companies. And then last but not least, we want to find companies that have been overlooked by other investors and have a cheap PE ratio, selling for low multiples. So we can go up to 29, but most of them, our PE ratio is down to, some of them, we found one the other day that was selling for under 10 times earnings. So you do find these kinds of bargains from time to time. Pretty rare. And that's why the 5-star trader has been so successful, because we don't just jump around, hit and miss and so on. We have a specific criteria that can help you choose the right kind of stocks. And you don't have to do any of the work. We do all the work for you through our screening process. And then even then, among the 50, we look at what the technical trade is going on. In other words, do we have a upward trend in the short term, in the medium term, in the long term? So I look at the technical side of this as well once we look at the 50 stocks that we find in the marketplace.
Yeah, and I want to mention that, some people might be going, well, how do you come up with 11%, 12%, 23? They're very specific numbers, but they are. We played around with this before we launched the service, and came to this is the right combination to really get the right stocks. And as Mark said, you got growing stocks at a good low price, so you get the top of the top.
Yeah, it's a great formula. So as you can see here, we're down to the top 3% of all stocks, usually around 70. Now, having done this program for like 10 years, there have been times when only 30 stocks appeared on the screen. And then there's other times when there's 70 stocks. So when there's only 30, that usually means the stock market's been roaring way ahead and there are very few bargains left and that sort of thing. But right now, I should tell you, right now we have over 70 stocks in our portfolio. So there's definitely some real bargains out there. And that's great because then we can go through, and I go through every one of them and on the technical basis to see which ones are in an upward momentum type of strategy. So of the 5 criteria, that gives us our list of stocks. But I use my own experience, our technical patterns, what news has come in on the program, what areas are hot and what aren't. And on that basis, we move ahead and recommend just 4 or 5 stocks at any one time for you to invest in out of the 50 or so that might be on the screening process. Now, in addition, since we have really been very selective on the stocks, we recommend that you buy the stock, but also for those who want to take a little bit more risk, we recommend a simple formula of using options. Options trading, as I tell my students at Chapman, stock option trading is the best way to make money in the marketplace, fast money, if you will, because you can buy penny stocks, you can buy futures if you want, and so on. But option trading is where the action is, and we keep it very simple. We recommend an out-of-the-money call option to create triple-digit wins. So if the stock goes up 10%, you're going to make 100%, 200, maybe 300% on the call options. Now that's a higher risk type of formula. It's not for everybody, but the majority of my investors, they really like to play the options market. So the 5-star trader is a great way to do that. So we see, actually, I guess we have, you're right, 2016.
So
So
7 years. It's over 7 years now.
That's 7 years. We've been doing it for 7 years. And Roger, maybe you can go into some of the detail on how well we've done.
All right. So the numbers are going to come up here in just a second. There we go. Since February of 2016, we've had 134 double-digit gains, 93 triple-digit gains. We even had one that was, quadruple-digit winner, 1,016%. And if you look over all the years, over 7 years, our average annualized gain is, I can't technically say 44%. So, that would, the SEC would come after me, right? 43.95%. So, just think about that. Basically 44% a year over 7 years. That's just a terrific track record. But it's because everything we just said, the screening process, you're getting the best of the best stocks at the lowest price. So it works. So we're going to walk through some of the winners that Mark has had and show you the difference on how you can make money on both the stock, but how you can really supercharge your percent gains on the options. And one good thing about the options is you don't have to put as much money into it. They are more high risk, but you're not putting as much money into it because one contract, a lot of times, we're selling contracts for, $5, $7, $10 each. But Penn, Virginia, we got 93% gain on the stock, but the option over 400%, 421%. So that really shows you how it just, is just you with that leverage, you're just getting a lot more gains. British American Tobacco, 8% on the stock, not too bad, but 159% on the option. And here's another one, T. Rowe Price, 18% on the stock. And again, that option, 258%. And Mark does a really good job of finding out, which options to look at. He's looking at liquidity. He's looking at, he's trying to find those lower price options. And Mark, you're usually out 2, 3, 4 months, right? So you have a little bit of time on these.
Yeah, it's a short-term trading system, and the options. So that's why we go out maybe 4, 6 months on the options. Give us some time so that when the stock moves in our direction, the options move up very sharply. So this is a short-term trading system, and so that's why technicals are extremely important. The fundamentals are very strong. All the 5 criteria are fundamentals, but we add on the technical system to make sure we're moving in the right direction, because one of the ways to beat the market is to invest in stocks that have some kind of momentum going for them at that particular time.
Right. Well, another one, Scott's Miracle-Gro, 17% on the stock, 424% on the option. So I'm just going to highlight a few of these. I'm not going to read every single one, but over 1,000% on H&E Equipment Services. We just talked about Scott's Miracle-Gro. 953% on Valero Energy, 496% on GM. Think about it, making on something like General Motors making 496%. But that's the power of the options and the screening process we go through. Here's some more: 421% on Public Storage, 386% on Alibaba Group Holding, 383% on Drive Shack. So you see lots of different types of stocks as well, because with the screening process, we find them in all sorts of different sectors. So that's everything the 5-star trader does.
Let me just add that just recently, as you know, the market has been very up and down, and it's been a difficult era for us. But I was just looking at some of our winners, and even though the returns aren't as high at 400% or 500% before, but we have had some real winners in very short-term periods of time. I was just looking at BlackRock Minerals, for example, that we just had a 4% gain, but that was in 21 days, and we had a 71% gain in the options just in 21 days. And Jackson National, which sells annuities, is just a really solid business right now with higher interest rates. So we jumped in aboard on that one. That showed up on our 5 screening process, and we made just 8% in the stock, but that was in 1 month. In 1 month, we made 8%, and we made 53% in the call option. So these are the kinds of returns that you can get even in a choppy market, or what we might even call a bear market, because as the old saying on Wall Street, it's not a stock market, it's a market of stocks. And so if we can narrow down what the stocks are that are doing well in a bear market, we jump aboard, we take advantage of the stocks and the call options. There's more risk involved with those kind of deals. It's not to say that we guarantee that to make money on every trade, but the long-term 7-year, you can see what the total return has been on the stocks and the call options.
Yeah. All right. Do you want to get into Mark, like the service, and tell everybody about the the hotlines and all that?
Yeah, so what we do is in the 5-star trader, we give you a weekly hotline. You get an email that will give you a review of our current positions, and probably almost like every other week, we make a new recommendation, because this is a short-term trading service. So we're selling our positions. We're taking profits on our call options, and in fact, so here's our strategy. So you will get a weekly hotline. If it's a new recommendation, we will tell you about the fundamentals of the company, why the 5-star criteria applies to this company, why it showed up on our screening process. We'll give you an update on what the stock is doing, and then we have a protective law. We set a stop order, usually around 20% of the stock, to make sure if it goes against us, we will sell out our position, cut our losses short, let our profits run. And then if the stock continues to rise, we raise our stop order so we can protect ourselves in case the stock goes against us. Second thing, we will recommend an out-of-the-money call option that you can buy that is relatively cheap. I look for the best one that will be 4 to 6 months hence, and you get that option. We give you the specific option strategy. So all you have to do is set up an account with Schwab and Company or whatever, E-Trade and so on. They all allow the buying of stocks as well as the call options, and then you're ready to go. And we have literally hundreds of people thousands of people who have jumped aboard these services and have done really well.
Yeah. Tell them about your strategy on the option side when we hit triple digits.
Right. So one of the things we like to do is if we double our money or triple our money, we sell half of our position, because options are very fast. You can make money really fast, but if you don't, if you wait for the market to long term, you're in trouble. So you've got to take these stock profits really fast, or option profits really fast. So we'll sell half of our position, and then we'll sell another half later on, and then we'll sell all of them. So we have like a 3-step process on the call option strategy, and that's why we have done so well on our call options.
So when we have, we have the weekly alerts that Mark just talked about, but, the market doesn't, if we want to take those profits that we're just talking about, we'll just send a real quick urgent alert out. You get it both via text and email, and it'll just be real short. Hey, our options just doubled in price. Let's sell half. Be real simple, real quick, and, you're on your way. And we just talked about the options recommendations. Mark already talked about the trade stops, the 20%. So if it goes down, it goes out of our way. Not our direction. We're not going to lose. We're going to limit our losses and then increase those as when the profits go up. We'll sell half on the options, but we'll raise that protective stop. So make sure you lock in the gains, because the last thing, we all been through it. You see a big winner and then you don't raise that stop loss, and if it turns against you, you never want to turn a winner into a loser. And so we make sure that doesn't happen.
Yeah, and in fact, on a number of occasions, special news comes out, like it beat street estimates. And that comes out every quarter with their earnings report. And if it beats street estimates by a surprising amount, the option can increase 70 or 80% in a day. And we often send out a special alert right at that point saying, sell half your call options, take your profits, because what often happens is the stock moves up dramatically and then just kind of slowly comes back down. And we want to take advantage of that in our call options. And so that's why we're a very short-term trading service, but it doesn't take very much time. You get the email, you can act on it right away and move on to your other aspects of your life.
Yep, and we're holding things an average, around 6 to 8 weeks in the service. So, it's short-term, but it's not day trading. So you don't have to be tied to your computer and your phone like every second of every day. And of course, we have a website that has all the information on it. So all the alerts we've ever issued. So you can take a look at what we've done in the past. We have special reports in there. It's one section that I don't think our subscribers go to enough, but we have some great special reports on our website as well. And Mark, you and I do these conference calls. You want to talk about the conference calls?
Yeah, we have a teleforum that we do. I guess it's every couple of months, right? And so that's a great opportunity for you to hear my current advice on what's happening in the marketplace, review some of our recommendations, and then we will give you a special opportunity to call in, ask a question directly to me. We have several thousand people who get on these calls, and it's really valuable advice, and we get a lot of great questions. I really look forward to it every year, every couple of months, as Roger is the moderator, and it really is a great opportunity to get to know each other through this modern technology.
Yeah, and our customers absolutely love those because, they can be right on the phone call, ask you a question. We do interactive polls through there so we can hear what our subscribers are thinking about the markets right now and get Mark's response on them. But that's, people, when I'm at money shows or Freedom Fest, so many people come up to me and go, thank you for these calls. These calls are just absolutely terrific. So as we've been doing all day today, we're celebrating our 20th anniversary of Eagle Financial Publications. And Mark, you're the one that we started Eagle with 20 years ago. Can you believe it?
Yeah, it's hard to believe you haven't aged at all. I have to wear a hat because I've aged quite a bit.
Yeah, I started when I was 9. So, but no, Mark, wow, 20 years, it's just been terrific. We started off with just forecasting strategies. Mark only had one service at the time, and now he's got 4 other trading services. All the people, all the gurus that you're seeing today on this live event are all part of Eagle now. It's been incredible. Mark is the one who started it with me 20 years ago, and I've got 2 daughters, and I call Eagle Financial Publications my 3rd daughter. So, but like I said, as we've been talking about all day, is we have this, with it being a 20th anniversary, we figured, okay, let's make these a great deal to get whole bunch of people to go in, try out these services, because we know once you try them, you're going to love them and you're going to stay with it. So for 5-star trader, it's normally $1,995 a year, but we have a special for the first month, only $20, $20 to match our 20th anniversary. So, and then after that, it's only $275 a quarter after that. So it's still a huge discount off the $2,000 a year price. So to take advantage of that offer, we've got a link in the chat box right now. And if you go to our website directly, you're not going to see this sale. You're not going to see this price. It's going to be $1,000 a year. So here you can do $20 for the first month. So click that link right now and order. Any final words, Mark?
Yeah, I think it's so important to try out something new, and it's just $20. You get a money back guarantee. You find out what kind of service this is all about and why it's been so successful. A lot of people ask me, well, how do you really get started in this business, especially if you don't really know what's going on? And of course, the answer is you just start investing, and that focuses the mind and will help you get to know these companies. You'll start thinking in terms of what works and what doesn't work. And it's just really an exciting process. So please, I encourage you to join us, and look forward to spending a couple of years together at least.
There you go. Absolutely. So again, click that link in the chat box, and that'll take you to an order form that'll tell you everything you're going to get, that special $20 price for the first month. So go ahead and click that now. And so thanks, Mark, for joining us. And up next, we have George Gilder. So I will be back in just a couple of minutes. Thanks.
Thank you.
Well, welcome back, everybody. I hope you're enjoying our free live event here on YouTube. And I want to remind you that we have lots of great content on our YouTube channel, so you don't want to miss any of it. So hit the subscribe button right below this video right now. We update every week. We have at least one new bit of information. It's all free on YouTube. And of course, we have these live events like this and many other things we have planned. So hit that subscribe button now. And next, as you can see on the screen, we have George Gilder from the Gilder Technology Report. And he's going to talk about you ain't seen nothing yet. And he's going to talk about the technological advances that you're going to see in the next 20 years. So he's a guy who's always been predicting things way before they happen. So George, how you doing today? And take it away.
I'm doing fine. How are you?
I'm doing great. I'm enjoying
Roger.
enjoying the show today.
Okay.
Hearing all the great content.
Well, 20 years ago, we were still in the accelerating phases of the microprocessor revolution, which I deemed the microcosm. And it has really reached a climax now with cloud computing and the dominant companies like Google and Amazon and Microsoft leading the world lists of the highest market cap companies in the world. Although in the last couple of years, the Aramco of Saudi Arabia has jumped onto the list, which is a portent of what I believe is the new era. And I think we're moving from the era of the microcosm to the era of the nanocosm, which is microcosms based on millions of meters, which most of the semiconductor industry expressed. And the nanocosm is based on billions of meters. So it's 1,000 times smaller. And the spearhead of this transformation into a new carbon age is graphene. And graphene is a material that's already had its hype cycle. It was discovered in 2004 in the UK by Geim and Novoselov, Andrei Geim, a great pioneer, and it is 200 times more conductive, more powerful than steel, stronger than steel. It's 1,000 times more conductive than copper. It's harder than diamonds, and yet it's also flexible, which 25% more flexible than rubber. It is as thin and light as paper. It's just a fabulous new material, but the way they formed it at the University of Manchester was with Scotch tape applied to graphite rocks. And that technique obviously didn't prosper. And the other technique to make it was chemical vapor deposition, at which you could make micrograms for mega dollars, millions of dollars. It's expensive, refined equipment used in semiconductor manufacture. And so this has restricted graphene to a few exotic applications, some of golf clubs even, but not becoming a real industrial product. And so this hype cycle happened. Geim and Novoselov got the Nobel Prize in 2010. And everybody got excited. And then the outcome was not transformative until Jim Tour, one of the 50 leading scientists in the world, according to recent listings, took over the lab in Rice University that previously was held by Richard Smalley, who also focused on nanocosmic technologies. He discovered buckyballs, C64, and experimented with carbon nanotubes, which also have all kinds of uses. But about 3 years ago, Jim Tour and one of his students, the Dewey Long, from Vietnam, invented flash Joule heating to manufacture graphene, perfect ribbons of graphene. Now they now sell for hundreds of thousands of dollars per some relatively small amounts. Produce it by the ton for under $100, and that is the big breakthrough. That means that this material, this single layer of carbon atoms in a kind of hexagonal pattern, that transmits electricity so accurately, signals so accurately, that it can refuse a severed spinal cord, and the spinal cord just refuses around the graphene inserted into it. It's you're just, or you mix it with concrete and you get you can use a 30% less concrete to achieve the same effects, or you can invent whole new forms of architecture to befitting this enhanced material, or you mix it with asphalt. You get no potholes in the winter because its thermal conductivity is greater than any other material. It's because it can be as thin as paper and as flexible as rubber. You can make touch screens that are hugely more foldable and wearable, or however you want to use them. Because it receives optical signals 100 times faster than existing optical switches. It's believed to promise at least 100-fold increase in the speed of the internet through use of these new graphene-based optical switches. Wi-Fi can be thousands, hundreds of fold faster. It's just a much. It just does almost everything better.
It's like a sci-fi movie. This is like
and within two years after Tour and introduced this material, and there have been some 16 companies formed to exploit it, spearheaded by Universal Matter, which uses this patented graphene manufacturing process, flash Joule heating, to transform garbage, any carbon waste, garbage, into perfect ribbons of graphene. But Tour also uses the graphene and the nanocosm to make nanorobotics. Is one of the companies in Israel that sprung out of Tour's lab. Israelis adopted this technology ahead of everybody else. It originated in Houston at Rice, but the venture capitalists in Israel immediately recognized its importance, and American venture capitalists are very much preoccupied with software. And this leads to a big investment opportunity because in general, all these wonderful new software enterprises all are dependent on previous hardware breakthroughs in material science and electronics and this and assembly and packaging, and all these advances are indispensable, and they're really what cause these great transformations, such as the Silicon Age and of information. And now we're moving into a new carbon era, and capitalism is always identified by its surprises. As Albert Hirschman, the Princeton economist, said, creativity always comes as a surprise to us. If it didn't, we wouldn't need it. And socialism, government planning would prevail. But today, the government plans to build thousands of devices to convert the CO2, precious CO2 in the atmosphere, into stones by gigantic trillion-dollar expenditures to launch a new Stone Age. That's really, whenever you hear the climate change alarms, just think they're preparing a new Stone Age for us. But meanwhile, entrepreneurs and inventors like Tor are rendering all these technologies, all these catastrophes, all these supposed disasters on the horizon into opportunities, not recycling or downcycling, but upcycling to new horizons of investment and capitalist creativity. And the new carbon age is at hand, and that these materials are now being made around the world, and they can change every technology. Actually, new technologies are always first retrofitted into old technologies, and so
can you explain?
Huawei's got a patent for a graphene transistor and on an 8-inch wafer, and that's an ingenious advance. But my expectation is that graphene won't usurp silicon information technology. It will transcend it and offer completely different kinds of opportunities, suggested by Universal Matter, among other companies. And there's a company in the UK, Cheltenham in the UK, that called Versarian, which is actually public in Britain, that uses more primitive ways of manufacturing graphene, or more expensive import ways, but they produce a whole array of new capabilities for electronics. So the first generation will kind of retool some of the fringes of our existing silicon age as it careens toward the end of a wall at the end of Moore's law. And we'll move into a graphene age of and we're on top of it. I spent a lot of time with Jim Tor over the last few years, and I feel very much the same way that I felt back in the 1980s with Carver Mead, who actually did the research behind Moore's Law. He's a Caltech physicist who taught with courses with Richard Feynman, the great Nobel laureate giant. And Carver just this year won the Kyoto Award, which is $1 million some prize as the leading technologist of one of the leading technologists of the age. And
So George,
and I feel the same way about Jim Tour. Soon we're going to see similar prizes extended for a similar transformation. You haven't seen nothing yet.
So George, not many may not know exactly what Moore's Law is. So can you explain that for those who don't know?
Well, Moore's Law was the proposition pronounced by Gordon Moore, who was one of the founders of Intel Corporation, the leading microprocessor and chip company in America. It's actually and Moore, together with his chief sort of research advisor, Carver Mead, contrived Moore's Law. And Carver did the research and named it. And Gordon Moore, though, proposed it and articulated it. And these figures propounded that essentially every 2 years, computer power would double on microchips. Yeah, the density of microchips would double every 2 years. And it for a while it was 1.5 years, and then it's sort of over the years it settled down to 2 years. But Carver Mead, back in 1980 or whatever it was, that Moore's in the 70s when Moore's Law was first propounded, Carver said it would exhaust itself when feature sizes got down below 50 angstroms, which is another way of saying 5 nanometers. And we just reached the 5 nanometers at TSMC this year. And the problems of tunneling that Carver predicted 40 years ago or whatever it was now are manifesting themselves and forcing Moore's Law to take new forms, but it's no longer the density of transistors on chips. In order to keep the progress in electronics, you got to move to parallelization. And companies like NVIDIA are leading this charge to having parallel processing rather than serial, one thing after another. You do it all at once at one time in a pattern called neural networks that Carver Mead also pioneered at Caltech, and which has made possible the success of AI, all this AI frenzy we have today is really neural networks and parallel processing, which was anticipated decades ago in Carver's lab at Caltech. But the key point is, yes, we're coming to an era when to get the same kind of advances, this kind of doubling with Moore's Law, you got to go to parallel processing, new forms of packaging, and but also new forms of communication. We're moving to light speed. So the whole industry is continuing to move ahead. In some ways, in optics, faster than Moore's Law. But what really transforms an industry is a breakthrough to a material with just unique and unexpected capabilities, such as graphene affords. And now graphene can be manufactured by the ton. and in coming years, it'll be manufactured by millions of tons, and that will make it the foundation for a new era, which will render all our concerns about CO2 and carbon and climate and all these things totally irrelevant and silly, as they already are irrelevant and silly. But politicians, once they fix on some idea, they just can't let it go. It doesn't matter how many times it gets disproven. If you got trillions of dollars you're spending to carry it out, there will be lots of static and noise in our economy for the next 10 years. And that's when the economy is filled with socialist static and bureaucratic noise and nonsense as it is today, and fake money to conceal the futility of all these crazy goals. Then that's the time you drill in. Entrepreneurs drill into the bedrock of true technological advance, and I think that's what's happening at Tor's graphene laboratory, at nanocosmic laboratory at Rice University, and in these 14, soon to be 18 companies emerging in just a couple years. Major startups entailing many millions of venture investment, and have emerged. And this is a powerful, transformative platform that all of our subscribers are going to want to know about.
Yeah, well, amen on that stuff about the government and everything. And entrepreneurs is where it's at. And in fact, you were just in Israel a couple of months ago. Can you tell us a little bit about what you saw out there?
Well, I met with Ariel Malik, who was the leading venture capitalist in this field. And I saw 7 or 8 companies. I met their executive graphene-based or graphene-enhanced or enabled companies, and saw how Israel has taken the lead, just as they did with the silicon economy. We all thought it all happened in Silicon Valley, but the fact is that Intel wouldn't exist today if it wasn't for Dov Froman, an Israeli who invented the non-volatile memory that saved Intel in the early years, and built the leading Intel fabs. The most advanced Intel fabs actually were launched in Israel. And today, many of Intel's leading products and Google's and IBM's all are really made possible by amazing inventors in Israel. And so that's why I go to Israel a lot. And I wrote the Israel test about Israeli technology and a few years back. And so that's one of the things that I do. I went to Israel, and then I went to Barcelona to the World Mobile Congress, where the beginnings of the adoption of graphene were manifest across this vast conference. It's the biggest wireless conference in the world, and graphene is eventually going to transform all of wireless technology. And these graphene supercapacitors can enhance charging functions for batteries 1,000-fold is what they estimate. I get a little jaded with all these estimates of 100-fold, 1,000-fold. But when you think of the semiconductor industry, how we moved from integrated circuits with Bob Noyce and and 15 transistors was a great miracle. And now we have 15 billion or more on Cerebrus wafer, new Cerebrus technology. So this idea of thousand-fold advances is not new to our history. And we're about to have a new industrial revolution as we move into the nanocosm.
Yeah, no, that's absolutely amazing. And I'm gonna get to your new book here in just a second, but I want to let everybody oh, do you have it? You have the new
I have
one?
it.
All right. Very nice. So that is coming out on the May 30th, I believe. Yeah. So, but first, let me talk about the newsletter, and then we'll talk about the book. So, as George mentioned, he follows all the technological advances and the companies at the forefront in his newsletter called Gilder Technology Report. He's got a couple of different portfolios. He's got a paradigm portfolio and he's got a special situations portfolio. And I was just taking a look before, earlier today before we started this whole event. And, in the paradigm portfolio, we've got some current gains of 54%, 69%, 84%, 124% on some of the open positions. So doing great. But his special situations portfolio, which started in 2020, 3 of the 5 current positions that are open are profitable, and he and his team have closed 17 positions. Every single one of them has been profitable, and if you annualize the gains, it's a 95% annualized gain. So some terrific stuff, and you only get this stuff by having somebody like George who knows this stuff, and he's in touch with everything. When he came back from Israel, he was so excited. He sent me and the team an email, and Peter Thiel was on the email. I mean, like, come on, like Peter Thiel. George knows everybody, but Gilder Technology Report. We have a special offer, as we have all day today, celebrating Eagle's 20th anniversary 20 years ago this month. I started Eagle Financial Publications. We had one publication with Mark Skousen, and now you've seen all the people that we have here at Eagle. It's absolutely terrific. So we're doing something very special to celebrate 20 years. You can get George's Gilder's Technology Report for only $20 a quarter. And that's you won't find that deal anywhere else. If you click on the link in the comment section, that'll take you to a special order page, and $20 a quarter. You can't beat that for all the information you get from George and his team. It's absolutely amazing. But let's we got a few more minutes, so let's you got a new book coming out at the end of the month that you just showed, Life After Capitalism.
Life After Capitalism.
Yeah, so tell us a little bit about that book.
That's really what I've been talking about so far today. But Life After Capitalism expounds my theory of economics that I've been working on since Supply Side and Wealth and Poverty, which was President Reagan's almost favorite book. When President Reagan was shot outside the Hilton in Washington, was rushed to the hospital, just as a week later, just as he was recovering in the hospital bed, he handed a copy of Wealth and Poverty to Bob Dole, Senator Bob Dole, who was the majority leader, and told him to read it. That's
amazing.
But I've been working on this theory of economics, which I call the information theory of economics, which really is applying the information theory from Claude Shannon and John von Neumann and Kurt Gödel and these great figures in history. Shannon being sort of one closely identified with the information theory that's behind the internet, behind all our smartphones and personal computers, that identifies information as surprise, and I believe that entrepreneurship is essentially the offer is surprises. You can judge the importance of entrepreneurial inventions and developments by the degree of their surprisal, how unexpected they are to the prevailing media hallucinatory world that most people live in. And when everybody else is entertaining hallucinations like a climate crisis, look at it out there, it's beautiful. By investing in these new forms of knowledge that are emerging, measured by their surprise. So wealth is essentially knowledge. That's one prime thesis. Growth, economic growth, is learning. And the learning is measured by learning curves, which are the most well-documented proposition in business economics. And Moore's law is essentially a learning curve, as I explained in Life After Capitalism. And money is time. Money is what remains scarce when everything else grows abundant, with spiraling new discoveries, new knowledge on the frontiers of our economy. What remains scarce is time. And money is most intrinsically time. And when the Fed or the Treasury or whatever manipulates money, it's essentially trying to manipulate time. And I don't predict a great future to that. Stealing from the future is not really a feasible way to run an economy. Ultimately, time-based monies will prevail, as gold was a time-based money. The reason gold became money was because the time it took to extract an incremental ounce didn't change significantly for hundreds of years, and that allowed gold to epitomize time in the economy. But now we have all these forms of digital gold as emerging from the crypto industry. And I have my arguments with a lot of the crypto leaders. I think Bitcoin is flawed because it has a cap. Real money is a measuring stick. It's not something that you cap and prevent from being increased as entrepreneurial activity expands and as new opportunities emerge. Money has to expand to endow them. And as John Tamny of Forbes says, you never can have too much good money. It's just bad money, the fiat fraud that really makes monetary policy such a constant alibi and conundrum for all the politicians. They all want us to be arguing about the refinements of money, while it's an inflation which is just bizarrely mismeasured.
Well, the beauty of doing something live, I don't know what happened with the technological glitch there, but we lost George. We were right at the end anyway. I hope you really enjoyed what he said. It was amazing. But give us just a couple minutes. John Johnson is up next. And again, to subscribe to Gilder Technology Report for only $20 a quarter, click the link in the comment section and you'll get George's insights and his whole team on all his picks and all the technology, tech picks. It's a great newsletter. So click that now. And again, John Johnson is next. We'll be right back, and let's hope the glitches go away. Thanks. Well, welcome back, everybody. I hope you've been enjoying all of our presentations today in our free live YouTube event. This is our third one we've done, and very excited about this yet again. And another reminder to subscribe to our YouTube channel. We have free content up there every single week. We put new stuff up there. So lots of great free information. So hit the subscribe button now and you won't miss anything. And up next, we have John Johnson, the editor of Rapid Profit Stock Trader. And easy for me to say, right? And I've only been talking all day, folks. So, you know, but anyway, I'll just turn it over to John. How are you doing today?
I'm doing great, Roger. It's great to be here. Another great virtual event going on. Yeah, this is a really interesting subject for me because I call it turning the corner to profits. And there's a little play on words there because I think it talks about the kind of stocks we're playing as well as kind of what I feel like is going to happen later in the year. We're going through some rough times. A lot of the market is not performing well, but I think that's going to change as we get through these issues we're working on now, where we're not so dependent on the Fed. When you finally figure out what's going to happen, where the Fed's going, I think we'll get more solid footing and direction. But the neat thing about what I'm talking today with this service is that it really works in any kind of market. And I know, some people say, well, in a bear market, stocks go down. That's true. They go down, you have problems. But the cool thing about the market in bear markets is that you cycle through different areas. You sit there and you'll go in and you'll have one sector that's getting beat up, and then you have defensive sectors that come back and they look really good while growth doesn't look good. Now, this market is a little bit different now. I get that, but we're going to talk about that anyway. But we're going to get to the situation where we can find stocks that are turning the corner, as I say, and we can find them, as I said, in any kind of market. And it's a stock service. We're keeping it really simple here because I was teaching this to some friends. I was trying to explain to them how to look for stocks that are ready to move higher. And I broke it down into really the simplest terms I could. And they were going, wow, you can make these pops of, 3, 5, 8, 10, 12, 15% on these things. And you can do it over and over again from what you're showing us. That's the beauty of it. And so that's what we're going to look at. We're going to look at this that we can duplicate over and over again. And that is the key. Find something you understand that's simple and do it again and again and again. And that's where this came from. So I'm going to share my screen now with you. And we're going to start in looking at turning the corner to profits using turning the corner stocks. There's my name. That's what I've been doing for all these years. A lot of you already know me. Got several services, but my philosophy is that you take what the market gives you. That is the key. Doesn't matter what direction, because as I said, this system is going to work in all markets. The goal, my goal, where I want everyone to be, is that you make enough money to do what you want to do when you want to do it. If you're doing that, then you got the world by the tail. And I think this system will help you get going there. So what the heck is a turning the corner stock? As I said, it got forgotten areas that can turn excellent profits in a short term as we catch them making these turns. You get these stocks that are in long downtrends. They're in big bases. They're flying under the radar, and they get just off everyone's sheet. They don't pay that much attention to them because, well, there's hot stocks in the market. And I don't know if you've ever noticed this, but when the economists keep forecasting either housing or whatever it is, they keep forecasting it's going to be better and better or worse and worse, as the case may be. Even as it turns, they're not really seeing it. Well, I make it my business to see these turns and to look for these downtrends or uptrends or long bases that are indicating change. Here we have an example. This is from 2021 to 2022, last year. And we see the downtrend here in CEMEX. It's the Mexican state cement company. But you start seeing change here. It's still in the long downtrend, as you can see by that white line, but it's starting to form a base. And a lot of people don't catch these things because they don't notice them until they make the moves. But look what happens if you catch them on the turn. You can play again and again and again. And that's exactly what we did, where I've been marking 1, 2, 3, and 4. We made those trades. And the point being, we catch the turn, it's a low price stock, and we make really good money on these bounces to the upside. So what do? Well, you know your market, and we can do that just by watching what's going on. Right now, what's going on in our market? We have banks that are an issue. It's very news-driven market. Yeah, it's not necessarily what we're focusing on right now, at least to the upside in this service. The banks are getting taken down. Okay, that's fine. There'll be great buys coming not too far from now, but they're going to have to go through the process where everyone kind of stops watching them and panicking over them. The other side of the spectrum, we've got those stocks that are performing really well. And I call them the too big to fail stocks. You know, we know about the too big to fail banks. Well, now we've got these stocks that are kind of like Apple, Alphabet, Meta, Microsoft, that people are buying, even though the economics are terrible. But you know what? They print money in the back room constantly. I don't know how to put this delicately. They kind of, play nice with the government and do what they want. So they're going to get kind of protection, and people are looking to them as a defensive area. I know it doesn't make sense. You got huge tech stocks that are defensive, but if you're too big to fail, well, you kind of get that treatment. And I mean, today you've seen them over the past several weeks, months, continue higher day after day after day. They move upside. So they're getting treated as defensive, but at the same time, we're seeing stocks such as precious metals and personal products, Colgate, Clorox, that sort of thing. They're doing very well. Very strange bedfellows out there. You got a defensive market, but you have these other stocks moving higher. That's great, but they're really, really expensive stocks. So what do we do? Where do we look? Well, we know that market leadership is narrowing today. There's not as many stocks that are moving up. If you look at the 200-day moving averages, where most of these stocks are, they're down below their 200. The majority are below the 200-day moving average. But we have these other stocks leading. We have to say, are there alternatives? So what do? We do exactly what I talked about. Looked at overlooked areas. We're looking where no one else is looking, that didn't participate in the rally. They may be dead. They may be doorknobs, not going anywhere. But then they may be starting. Maybe they're showing signs of moving. So we look at the overall direction, what's happening. We look at these cycles, what are they doing? And then we know that the time will come again when these stocks move back up. So we pour through the market, looking at sectors, and then we'll find out which ones are starting to show. Maybe they're not ever going to move to new highs. I'm not saying they're going to be the big NASDAQ names. But as I said, we can get 5%, 10%, 15% moves in short order with these setups. So how do we go about finding them? Well, we're going to start with those quiet, out of favor, quiet stocks, not in the headlines necessarily. And then we draw trend lines. We start looking for what's going on in these areas. Is there anything happening? So there may not be anything. So, well, we can't look at the thousands upon thousands of patterns that are out there or each stock chart, but we can look at the sector leaders, and that'll give us an idea. Oh, there's some money moving here. Now we're going to go over some of those reasons, some ways we show that, but we start seeing just different. I mean, it's like if the weather in the summer, it's hot every day. Down here, they give a forecast. It's going to be 95 degrees with a 20% chance of rain. And they'll do that every day. Then one day you look out your window and they say, it's going to be 95 degrees and 20% forecast of rain, percent chance of rain. You look out your window and you see clouds out there, you see some wind blowing. You know something's changing, and that's what we're looking for. We're looking for the change. Here is the Amex Gold Miner chart, and this is back in whenever, it doesn't matter, 2021, 2022, and it's just heading lower, 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 lower. No one, out of favor, no one loves it. But okay, this is November, is at the end of this chart, and November here is almost right in the middle, and I'll be done. There was change ongoing there. And Roger knows this because I was talking about this change at one of the events that we were at. And as you can see, we've had a complete change of character here because we were watching these stocks way back then. We saw that and we got in on the early moves. So we look for signs of what I call a character change. You're changing. You come out of prison and you're changed your ways and you're going to go upside now. They've been banished, but now everyone starts finding them again. So we look for just oddities in a trend, like a trend is flattening, a range is tightening, they're bumping up against a trend line, there's increased volume, there's some volatility bouncing around where there was nothing before. Or MACD, it's a good momentum indicator. I know people, oh, MACD, yeah, don't use it for everything. Use it for highs and lows.
Explain MACD, because maybe not everybody out there knows what it is.
It is. I'm going to show a chart next. It kind of, let's just bounce on forward. The important thing is we're looking for trend change signals. And what I'll show you here, down at the bottom of this chart, you can see MACD. It is an oscillator that it takes over time and averages movement in the stock using different, you can set it for different intervals. I've got my intervals that I set it for. I didn't put it on here. You can always shoot me an email and I can get those for you. But what I look for is an oddity. We see an aberration here. Do you see it? This is a steel stock, and we're looking back in 2022 when metals were going down still, but we started seeing changes. MACD puts in higher lows as the price continues to put in lower or stagnant prices. The pattern was flattening. MACD was putting in higher lows. That's pressure. Think of that as pressure. They're at odds with each other. So you're getting a trend, you're getting upside momentum building. Then we see a break through the trend line and a test. And then we see, it made the break, and now it's flattening that pattern out. Volume quiets down after it picked up, and we were getting ready to move in because we knew the trend was changing. You can see we started making these trades when they showed up. Nice quiet period, nice quiet volume, and then we got the break, and that was our signal. Buy into it, and we make rapid changes, 10% in the day and a half on these moves. Yeah, we can capture more, but we have certain reasons we took gain. We had old highs and gaps that we were looking at here. And remember, the purpose of this is to lock in those strong, fast moves. Now, what did we do? We got a new play set up and we played it again, Sam. That's what you can do here. You can we know there'll be consolidations and pullbacks after these brisk moves to the upside. Yes, you can. I see my slide says I exited at 305. Yeah, that was a move, but it wasn't that move. But in any event, I'm showing you where we went in, where we got out, and you make these solid moves, let it test a little bit, and then move again. But you can see we're getting the shift here, the big picture. And that's what I'm looking for when I start looking at these. Where am I getting these shifts? When I start seeing a lot of these lining up, I know we're in for something good. Now, another thing we can do, look for bases. I know looking at a base can be something of an art form, identifying it. And I look at thousands of charts, so it's secondhand to me. But the cool thing is, with my service, you don't really have to worry about that. But I know a lot of people want to fish for themselves. I get that. But we look for bases that are forming typically at the bottoms. You get a cup, a big rounded bottom. You get a reverse head and shoulders, which is kind of an offshoot of that. Large patterns that form over time tend to be overlooked. Everyone gets bored with them. They're impatient. And I'm not saying we're playing them. We're not sitting there, okay, we're going to buy this and wait 2 months for it to break. No, we're going to catch it, like I showed, when it makes a move. So we get these large cup formations. We get even double bottoms setting up and a head and shoulders formation. What we want to do is play them, not wait until the pattern is fully developed. No, the cool thing is we're going to get in there as the pattern is developed because we understand how they form and why they're forming. And we can get in kind of the ground floor and play them as they move up once, twice, over and over again. Sometimes I know people just buy them and hang on to them and then play them individually as well with some extra money.
Well, I think was good, talking about the overall trend is what John does is he's looking at that, what he called, and other people call boring, but he's looking at that so he can get the smaller trends. Because if you're not looking at the bigger picture, you're going to miss those smaller trends. And that's what I think John does really well.
Absolutely. Big trends lead to big moves, but you have a lot of smaller moves inside of the big moves. And you got to catch them. And it's all about timing. I mean, you can catch the last moves in a run. And I've had programs that we talked about that before, but we like to catch as many as we can. I mean, hey, I may be greedy. I don't know. I just want to catch the stocks as they make their moves and catch as many of them as I want to. That's what we do. That's why we're investing and trading in the market. So we look to see are any bases forming. As I said, they don't have to be fully formed. That doesn't matter because we can make money as they go through the process of finishing the base. I know there's newspapers out there and others that talk about playing a base after it's formed, and that is fine. Yes, that's really good, but we don't have to wait for that. As I said, we understand what they're doing, and if they break out, we're going to make even more than we did before, because we can alter the trade, then keep doing what we're doing, but then make longer term trades as well, just buying some stock and holding it, as I said. But I kind of like to play the trends. And here we can see McEwen. It's one that I talked about back in November, October, November. We were seeing it set up. It was one of the mining stocks, the precious metals miners. And you could see it starting to set up. It had been trending lower and lower, but it started to flatten. Trend was flattening, came up, broke it, came back down, but then held the area, and then it started its move. And the key is, you can see this orange line, you can see this is the cup starting to form. We recognize this is what it was doing. It doesn't mean it's going to have to form, but we're watching in case it does, because we were seeing character changes in the market here. The yellow line is, well, as it continued to form the right side of the cup, we were able to make plays on the way up. And then when it broke out from the cup with handle, well, we were able to make plays there as well, long-term and short-term. But you can see we got the same issue. We got the positives here of the rising MACD as prices were low or stagnant. So we were getting the pressure, we were seeing it form, we started to see volume kicking up and then dropping on declines. It was showing all the right things that we want to see. So when you look at the bases, like, okay, are these ready to move? Well, bases are going to give signals, as I was just saying. They're going to be quiet and then show get a little fidgety, a little jumpy. You start seeing spike, volatility of the price move. You see volume kick up. I call them kind of get ready spikes. You just see one day the stock just sitting there and the volume just leaps up. What was that all about? Well, that's what I call a get ready spike. There's a lot of accumulation ongoing when you have those. When the stock is down near its low and you get big volume, that shows that big money is buying. It's often quiet, but those big money, those spikes are when the big money makes a big buy. You get bumps of resistance and a fade, but it keeps coming back. It doesn't know it's beat. That tells you that something good is in process and to get ready. So we're going to enter when the stock breaks out. We can enter it on the breakout test. We can enter it before it does that, as I've shown, and we can do it again and again and again, because breakouts provide a series of plays. And pre-breakouts do. Not a lot of people look at pre-breakout stocks, but again, if you understand what is happening, you can start your profit making a lot earlier than waiting for the pattern to completely develop. Harmony Gold was a similar, not as long-term. The stocks had already started to move up, but hey, Harmony had made the turn because they made those back in October, November, December, but they'll come back and they'll make periodic trends lower to test and consolidate. Well, we see a trend line forming. It came up to test it. It went down to the same level, and then it came right back up to it, tried to break, couldn't, and then it gapped. Well, there we go. We were ready then. As soon as it tested and started back up, boom, we were in the trade. We banked a nice profit. It came back to test it, made a little bit more. We didn't get the whole thing. It came back, started up again, boom, we were in it again. And that is the continuing move after the initial turn. Again, as I said, we catch them on the turn. It just increases the number of times we can make money off of these stocks. And again, you can buy into some, and quite frankly, I do it too. Buy and just hold these when I know they're turning like this, because I'll just let it go and let it continue to move as long as all the fundamentals, the technical indicators remain positive, and let it make me money. Same thing with CX. We talked about this earlier. We played this.
I just wanted to point out in the last one, one of those trades was in 2.5 weeks. You made 10%. The other one's a little bit over a week, and you made almost 9%. I mean, that's terrific. That's not bad work for a week or two.
Yeah, and that's I don't have the exact numbers on that right now, but we will literally go from a day to 2 days on a trade up to a couple of weeks. Typically, that's what we do, and so. Sometimes it takes longer, but most of the time these are what we're hitting because we're catching them when they're moving, catching them when they're making their moves. And here's CX. We talked about it before. I didn't have room to put all 4 trades in on this one here, but you can see even on this first one, we didn't catch this very first one. We just we were letting it test a little bit, and we boom didn't catch that one there, but we catch the really good setups, and this probably wasn't bad. But we catch the really good setups. I like it when they come back to the 50-day here and just make that pop, because they will pop off of that because it's an important level that a lot of people watch. I guarantee at this point, a lot of people are starting to watch these stocks because they're seeing them make these moves. That's okay. You know what I say? We're going to let them push our positions higher. We get in there, we start making the trades, and then other people say, well, we need to buy this. And we let them. It's a great feeling to let other people buy your position and drive it to the upside. Thank you very much. Ka-ching. So a few other things, talking about just making the trade. We have a service where we send out alerts. We give you just a real specific buy it, sell it. No fancy back there. But, for each trade we send, and before you enter any trade, you need to know your numbers. You need to know where your target is, where your gaps, prior consolidations, moving averages. I have a saying, I don't like to plow a lot of new ground if I can avoid it. I prefer to play between resistance levels and support levels if I can. Because if I can take a fat 10, 15% gain out of that, I'm going to do it and be happy as can be about that, particularly in a market that shows bad economics. We're not looking so great right now. I think that'll change, but you don't want to have to, oh man, I'm going to need this stock to break this resistance and then to go another, $5 up here to make my money. And well, can it do that when, the banks are selling off and people are taking money out of the banks? Yeah, don't really want to be doing that if I can avoid it. So I like to know my resistance levels. I like to calculate what my result's going to be before I enter. So I can say, yeah, I can play this one. And if it stalls at that resistance level, boom, I've got it. So I can place my target such that I can take an easy chunk of gain and then look for the next trade. So been talking about this, and it's the rapid profits stock trader. And that's what it's about, rapid profits, because as I've showed you, we're looking at stocks that are turning and ready to make a move, not sit there all summer, all fall, all winter. No, we're looking at indications that show there's a lot of buying ongoing that's going to send them higher. Now, we target stocks that are lower priced. As I said, we want the lower prices. That gives us better leverage with our money. That means you don't have to throw $100,000 at a position. You can if you want to, but you don't have to, and you'll make good money. The percentages are good. And the thing is, we're not having to ride these forever, as Roger pointed out, to make a really good return, because it's part of the model. We're not chasing $100 stocks. And so the model is we find these really quality patterns that are ready to move, and we can leverage our money and get better returns that way. We send out trading alerts, typically 1 to 3 buy alerts a week. Depends on the market conditions. It really does. Are we getting the setups that we need? And you'll find that there'll be times where it's kind of slow, and then times when it's fast. And there's an old saying my dad always taught me when we were talking about business and markets and trends. He said, if the fish are running, that's when you got to have as many lines in the water as you can get. And so we'll take 3 trades or 4 trades a week if they're there, and it can happen fast. And I haven't heard anyone complain about that when we have a lot of trades turning nice profits in short order. So the trading alerts format, there's no jargon, 0 jargon. You will get a buy alert. You will get a sell alert. They come via text and email. And if there's something I need to put in there, if there's something a little different, I'll say it. But typically I don't, because you get to know the story. Buy it here, and we'll let it make its move, and then you'll get the sell alert. That is, we try to keep it as simple and straightforward as possible, just like what the stocks we're looking at. Not getting any crazy, it just broke out and we're going to do this and that, and we're going to play it when it gets back to the 38% Fibonacci retracement. We do that on other services, don't get me wrong, but that's a lot more involved because we're using a lot of options and that type of thing. And also, you're going to get every day a summary table, our main table, where we give you the changes of our positions and what's happened that day. And of course, you always get access to our web portal. And the last thing that you also get access to is all the hard work that we do. So your time is spent just executing the trades and being happy with the profits that you make. So
John's, before you get into that, some services, you hear about the CEO, people write about all the stock and, why it's wonderful, why it's this, and it's this beautiful story. And some, that's good for some people and for some services. But if you just want, here it is, the charts are telling us buy now. We're going to tell you, where we expect it to go. We're going to tell you exactly when to get in and out. It's quick. And
and that's, I'd like to expound on that a little bit more. There is nothing wrong with knowing about a company, but I've owned in my past life a long time ago great companies that didn't do anything for me. I mean, they were wonderful. They made great products, but it just wasn't their time to move. And so I changed the way I looked at investing and figured out something that would work for me. And this is one of the things I learned early on is stocks make turns and move rapidly. And, it's just numbers, it's probabilities. I can't say I don't care about who the CEO is. I really don't. But I care, the stock is telling me, the chart is telling me whether this stock is worth my money now, not the CEO telling me how great business is. And we know how honest CEOs always are when they go on the financial stations. I think the stock chart is probably the most honest picture out there. I'm not saying it's 100% honest all the time, but most of the time it gives you the absolute scoop on what this stock is doing. And that's why I focus on those.
All right, so we have a special offer, as you see on the screen here.
Yeah.
We've been doing the 20th. We've been doing the 20th.
Let me tell you about that, Roger. It's typically, this is $795 a year, and depending on how much money you throw at one of these positions, if you pop 10%, as we do often, boom, you're done. You got it back. It's all profit after that. But Roger always comes up with something where he gives my services away, and you get your first month for only $20. And I don't know if I got that absolutely right, Roger, but I think that was the thing. When you explained it to me, I kind of shut you off at that point and didn't listen to you anymore. But he knows what he's doing, not me. But anything else you have to say, fine. We got a link on the screen that you can get onto, but I really think you give it a shot. because you're not going to get your inbox just flooded with a bunch of me prognosticating about things that I really think I know about, but I have no control over. I mean, yeah, I can pin some pretty cool stuff sometimes. I talk a lot about the too big to fail, NASDAQ stocks now. People look at me like, wow, really? I'm like, yeah, well, that's my opinion. It's kind of a cool thing, but it just seems to be the case. But it's all based on those charts. So in any event, this is a service where you don't have to get in deep to make great profits. And it appeals to a lot of folks. I think you'll be happy with it.
Yeah, so the first month is only $20, so it's a great price. As if you've been watching all day, Eagle is celebrating its 20th anniversary this month. So I started Eagle Financial Publications 20 years ago. I was like 5 years old, right?
Yeah, I was 10.
But we want to give everybody an opportunity to try it out, because I know, $20. I mean, what can you get for $20? Almost nothing nowadays, especially with all the inflation and everything, and barely eat at McDonald's for $20. Two people, it's like 25, $30.
I can't get a pair of bike socks for $20 now. It's crazy.
So it's a great deal. We made it a great deal to, $20, obviously, to celebrate our 20th anniversary. But we want to get you in, because I know if we get you in, you start making money, you're going to stay with us, and that's what it's all about, is making money. And Rapid Profits Stock Trader has been doing it extremely well. It's a very popular service of ours. That's actually John, actually, I didn't mention this to you, but I was looking at numbers this morning. It's actually Rapid Profits. We're at an all-time high of subscribers right now, so it's doing terrific. People love it. So try it out. Click that link in the comment section. That'll take you to the special order form for only $20 for the first month. If you go to the website, our regular website, you will not find that offer here. It's special for this 20th anniversary YouTube special we're doing today. So, John, thank you so much for going through this today.
I will say one other thing. I know that if you like the service, and you will, and then you want to hear what I have to say, which on some of my other services, I publish a market summary and overview every day, talks about the market and the economy. I'm sure Roger will cut some kind of deal for you on that as well.
Well, let's get him in the door right now. But yeah, that commentary is fantastic. We have lots of people who just buy it just for the commentary. It's awesome. But $20 for Rapid Profit Stock Trader. Again, thank you, John. And up next is going to be Bob Carlson. So we'll be back in just a couple of minutes. Thanks. Welcome back, everybody. I hope you've been enjoying this day full of great information. We're got about 3 more to go here. We're on the home stretch. Before we get to Bob Carlson, let me just remind everybody to subscribe to the Eagle Investing Network by hitting the subscribe now button right below this video. And we have information every single week we update. Of course, we do live events like this, lots of great information, and it's all free. So go ahead and click that subscribe button now so you don't miss any of our free information. And next up, we have Bob Carlson, editor of Retirement Watch. Bob, how you doing today?
Yeah, I'm doing well, Roger. How are you?
I'm doing great, enjoying this great day in front of this great audience, and we'll let him load up his presentation here and turn it over to Bob and let him, talk about how I spot turning points in the economy and the markets.
Well, great. Thank you, Roger, and thank everyone for joining. Well, I'll just get right into it here and start this presentation. As Roger said, it's how I spot the turning points in the markets and the economy. And as you know, many people, while they might be buy and hold with part of their portfolio, they like to be tactical with at least part of their portfolios. They want to change their portfolios in response to the markets and the economy. And if you're going to do that, it's important to have a process, a formal process that's you've written out and set down, and you need a system to make these tactical changes. You don't want to be altering your portfolio based on the latest headlines or the latest hot strategy or theme. You want a time-tested process that you're going to follow, even during periods when it doesn't appear to be working, because most of these tactical systems, even the ones that have really good long-term records, they have periods of time where they don't work. And by all means, you want to constantly be doing research and testing and looking for new insights. But as I said, you don't want to be just jumping around with the latest updates or the latest news and headlines. So it's important to keep in mind that many investors try to anticipate economic and investment changes through tactical investing strategies. And because of that, a lot of people's views and insights are already reflected in market prices. So what you need to be doing is anticipating what's going to happen next, because even if you know what's going to happen with the economy, if it's already been priced into the markets, it's not going to do you any good to implement that, because the profits are already in place. So the markets already reflect what most people are thinking and anticipating, and you want to have an ability to kind of see what might be happening next that's not already reflected in the markets, that most people don't already think is going to happen. So that's going to be the key to success if you're going to be a tactical investor, is to anticipate what might happen going forward that's not already reflected in the market prices. Now, investments respond for the most part to the economic cycle. In the short term, they might respond to other factors, but that'll be temporary. For any enduring change in the markets, it's going to be economic factors that are going to influence prices. And the two main factors that are going to affect prices are economic growth and inflation. So we're going to look at how investments respond to economic growth and inflation, and then look at some key indicators that can tell you what's going on and help you anticipate what might be changing. In particular, I'm going to emphasize the early recession warnings. These are the most reliable data I can find. There are other data that can help with other parts of the economic cycle, but the early warnings of recession have been pretty effective over the long term. And also, avoiding a recession or knowing one's coming is really good, because it helps you avoid the big losses. And the big losses are what really hurt long-term returns. So if you can just do reasonably well the rest of the time and avoid the big losses in recessions and bad bear markets, you'll be in pretty good shape. Now, as I said, the two big factors are economic growth and inflation, and each of those can be rising or it can be falling. So, and they can be doing that at different times. Growth can be rising while inflation is falling. So you have several different scenarios there of what could be happening at any particular time. And so we're going to look at that very briefly and see how that affects different investments. Here's an example of the different the different parts of the market cycle. You go from an expansion to a peak to a contraction and then to a trough, and then eventually another expansion begins. And then on the outside of that circle, you can see what's going on with economic growth and inflation during each of these parts of the cycle. Now, each day-to-day, week-to-week part of the cycle is not exactly the same. For example, during the expansion, you'll have periods of time when both growth and inflation are rising, but generally throughout that full cycle, growth is going to generally increase while inflation is going to generally fall. So that's the thing to keep in mind. This is the big picture. This is what you're looking at. This is where you're trying to find the different turning points and spot them before most people do. Now, during each phase of this cycle, this is in general how the different investments respond. Growth is good for stocks and corporate bonds, for real estate, also real estate stocks, and also for commodities. And that's pretty self-explanatory because there's demand for all these things increases during a growth period. And then, of course, you don't want to be owning a lot of these when growth is declining. And instead, bonds do well, as does gold and the dollar for the most part. And then here's what responds well to inflation and what does well when inflation is falling. Typically, the assets that do well when inflation is falling also do well when growth is increasing. So that's the big picture of the different asset classes, how they perform in these different parts of the cycle. And that's something you want to keep in mind. Once you've identified where you are in the economic cycle, look for the assets that do well in that part and reduce those that do poorly. Now, what's interesting is inflation and inflation hedges. Typically, people expect gold to do well when inflation's rising. But we've actually found that there's no one really reliable inflation hedge. And that's because different factors affect each of these inflation hedge type of investments. And I've listed the 5 main types of investment hedges here, but none of them respond solely to inflation. They also tend to respond to other factors. And so that's why we can't have one really reliable inflation hedge. We've seen that the last few years. We saw gold increase in value substantially in 2020 before inflation was really being reflected in the data. And then as inflation started to be rising in the CPI and other measures of inflation, gold declined. Same thing with TIPS, Treasury Inflation Protected Securities. They should rise with inflation, but instead they rose before inflation rose in 2020 and part of 21, and then declined until recently. So instead of looking at just one inflation hedge, when you think inflation's turning higher, I would recommend a basket of these inflation hedges. Buy the whole group because some will do well in one inflation cycle and not in another inflation cycle. Or you can get a mutual fund that does invest in this basket. One that's got a particularly good record is the DWS Real Assets Fund, and the ticker on that is a AAASX. There are other real return or real asset funds out there, but I find this one has been doing this the longest. It has good tactical instincts as well as just having a good long-term portfolio for inflation. So rather than looking for one inflation hedge, I would buy this basket, either individually through your own assets or through this mutual fund. Now, as I said, the key here is to spot turning points and to try to find the data that's most helpful in spotting those turning points. It's important to know that no data point or data series has a perfect record at picking turning points, but there are several that have very good records. And you want to look at data that gives you a indication of a turning point as far in advance as you can find. Even the ones I found that are most reliable don't give you a lot of advance notice, but any kind of advance notice is good. And as I said, the ones that provide early recession warnings or early warnings of recession are the most reliable. The others, while they're out there and while we're going to go through them, they're less reliable historically than the recession warnings. Now, the most important thing is the Fed. You know, the adage, don't fight the Fed. The Fed has the strongest influence on growth and inflation. So you want to be looking at what the Fed's doing. And the best way to do that is to look at the Fed's balance sheet and the monetary base. These better reflect what the Fed is doing than other indicators do. Interest rates are one factor, and we'll look at that briefly, but the important thing is the monetary base. This chart is just the last 10 years of the monetary base, and you can see how it's gone up and down. And if you know GDP, what it's done, what inflation have done in the last decade, you know that it pretty much responds. They both pretty much respond to what's been happening in the monetary base. And you can see it's gone up and down, and you can see a little upward blip, but on the right side there, you know, it was steadily declining when the Fed decided it wanted to cut back on inflation, but it went up briefly recently, or went up sharply recently because of the regional banking crisis with the Silicon Valley Bank and others. So we're going to see if it continues to go up, if the Fed decides it needs to put more liquidity into the economy because of this banking crisis, or if it can go back to fighting inflation. So this chart is the total monetary base. This one is the 12-month percentage change. This shows you better how the Fed is changing policy and to what extent it's changing policy. The other chart, it's less volatile, so it doesn't really show really the sharp changes that can occur within a short period of time in Fed policies. For example, here you can see that when the economy started to slow down in 2018, the Fed started to inject money to restore economic growth and improve the stock market. And then we have this big jump in the monetary base during the pandemic, when we needed to put a lot of money into the economy, and that started coming down about mid-21. So even before the Fed started raising interest rates, it started reducing the monetary base. And here again, you can see on the right side that blip upward because of the banking crisis. And that's something I'm going to be watching to see if the Fed's going to restore its inflation fighting policies, or if it's slowly abandoning them because of the slowdown in the economy and the effects on these regional banks and other banks. So that's the first thing to look at, is the monetary base. What's the Fed doing with its balance sheet, with the total money in the economy? And also short-term interest rate. The Fed can only control and strongly influence short-term rates, so I watch those. And here you can see this really historic rise in short-term rates once the Fed began tightening policies in early 2022. And those rates have stayed high, even though the markets indicate they expect rates to be coming down. They expect the Fed to start easing sometime in 2023. So far, it doesn't look like that's likely to happen. For the overall economy, a very good indicator is retail sales. There's two ways to look at that. There's nominal retail sales shown here, and there's also real retail sales, which are adjusted for inflation, which we'll look at very briefly. Here's the 12-month percentage change. And the way this indicator works is very simple. You look at the change in retail sales over the last 12 months. If it's positive, then we're likely to continue with an economic growth period. If it goes negative, you can see a couple periods here where it went negative. Those were recessions. So generally before a recession, maybe just a few months before sometimes, retail sales, the 12-month change will turn negative. And here you can see on the right side, retail sales have steadily been coming down over 12-month change, but they're still above zero. And here they are adjusted for inflation. And here you can see that when adjusted for inflation, they've already started to go below zero. So we could be in a recession or very close to a recession based on this indicator. And that's reliable because we've seen stocks coming down. We had the bear market start back in 2022. So investors who are optimistic about the economy not having a recession, this data makes it look like that could be an iffy proposition. So this is something to watch very closely over coming months to see if that remains below zero or if this is just a brief blip and it's going to bounce back upwards.
Yeah, I mean those if you go back real quick, I mean the on the right side there, you know, you can see the COVID, like the COVID effect, I guess, look how sharply down it was and then how sharply up it was because it's a 12-month percent change. I mean, that's historic. I mean, there's nothing anywhere close to that anywhere else. It's pretty interesting.
Yeah. Yeah, the drop in retail sales and some other data, very extreme during that period. It's really made it harder to analyze a lot of these charts because you have to have a much bigger spread on the left side of this chart to get that in there. They're usually easier to read than they are now because of how you have to incorporate this COVID data.
Yeah.
So industrial production, another very good indicator of the overall economy. And again, you just look at the 12-month percentage change. When it goes below zero, we're likely in or very close to a recession. And you can see this is the gray bars on this indicate recessions. And you can see this has been a very reliable indicator of recession, often indicating that months in advance. The only false signal here was in 2015 over towards the right side, where the Fed had started to tighten monetary policy. It was starting to try to reverse its post-financial crisis policies. And when it did that, industrial production fell, other parts of the economy fell very quickly. So the Fed quickly reversed policies and so prevented a recession. Some people think that this was also a false indicator because so much of the economy has shifted towards services and industrial production and manufacturing because they're no longer as big a percentage of the economy as they used to be, or not as good indicator of whether recession's coming or whether we're in one. But except for that 2015 period, this has been a very good indicator. As you can see over all the way to the right, industrial production is just barely above zero, going over 12 months, and it's, as you can see, been steadily declining. So this is, again, another indicator to look at very closely in coming months because it's looking like we're in or very close to a recession. Another good indicator is unemployment rate. Now, employment is usually a lagging indicator. Generally, businesses, they will first reduce capital expenditures, stock buybacks, maybe dividends, a few other factors. And laying off people is kind of the last step they take when business is declining. So for the most part, the labor market is a lagging indicator. In fact, in a number of recessions, job growth has continued and the unemployment rate has stayed low even after other data indicated we were in the very early stages of a recession. So definitely, for the most part, employment is a lagging indicator. However, historically, if you take the 12-month moving average of unemployment, then it's a very good indicator. It usually gives us indication a few months ahead of time that a recession is on the way. So here, you can use these two lines, the regular unemployment rate, which is the red one here, and the blue one, which is the 12-month moving average. So if you track these two, when the current one, the red one, is above the blue one, then we're in a recession is likely just a few months away. The red one is the current rate, the more volatile one. So when it pops above the blue line, that's when we're very close to a recession. But when the red one, when it's opposite, then we're doing okay. Now here, you look at the right side there, and we're very close to a turnover point. We're not there yet. The current unemployment rate is still below the moving average. In fact, in the latest data, it dropped a little bit more. So it's actually farther away from the blue line than it was before. But we're still very close here. And this is another piece of data that's kind of harder to read now because of these spikes that occurred during COVID. But it's proven to be very reliable over time, typically gives an indicator a few months ahead of time of whether a recession is coming, and much more than other data do. So inflation is next. The two factors are growth and inflation. We looked at data that might indicate what's happening with growth. So the next factor is inflation. This has been harder to find data that work effectively. It's been particularly hard the last 20 years or so because there have been a number of factors, long-term secular factors that have kept inflation low despite big boosts in monetary policy. Typically, you could simply watch the Fed, and when it boosted the monetary base and tried to ignite economic growth, then you could anticipate that inflation would start increasing about 18 months to 2 years later and steadily increase after that until the Fed began to tighten. But we had these long-term factors such as globalization, the decline in unionism, the strength of businesses versus labor, reduced regulation and taxes that kept the economy growing, allowed the Fed to continually boost the monetary supply without triggering high inflation. So typically you would just watch what the Fed was doing, look at those monetary base numbers that we discussed earlier, and that would tell you what inflation was doing. That has not worked as well the last 20 years, but it began to work again around 2018 period as these long-term factors tend to roll off. Globalization started to reduce, labor market became the labor force had more power because the labor market became tight. Governments tended to favor businesses less than they had the previous 20 years or so, tightening regulations, increasing taxes, and so forth. So since about 2018 or so, looking at the Fed, what it's doing has again been a good indicator of what's likely to happen with inflation. So for inflation, for sure, follow the monetary base. Also follow earnings. Inflation can't increase unless workers have rising incomes so they can pay higher prices for their goods and services. So it's a good thing to look at the 12-month change in average hourly earnings. And here you can see that for a long time, this was very low. Growth in earnings was 2 to 3% a year. Then it gradually started to increase in the late 2010s. And of course, it spiked up during the pandemic and then spiked down. And so now we're in a more level period. It's still well above what is necessary to bring inflation back to the Fed's 2% target. While it is declining, it's not anywhere near where it needs to be to meet the Fed's target. Average hourly earnings should change 2 to 3% a year if you want to have a 2% or so inflation rate. So the average hourly earnings, along with the Fed's policies, indicate inflation is going to be with us for a little while longer. And as long as these earnings stay high as they are, it's going to be difficult for inflation to come down simply because workers are going to have the money to pay for higher prices, even if the economy overall is declining. As long as unemployment stays low and earnings growth stays high, inflation is going to be above the Fed's target. So you're going to look at this data. This is the data I look out regularly for Retirement Watch when I'm deciding what to do with our portfolios. And the basic way to use this is the economy is going to be in a growth phase most of the time. So you want to have the bulk of your portfolio positioned for growth. We discussed those assets that do well during growth periods earlier. And so we have the bulk of it in growth. And remember, growth and inflation can be increasing at the same time. So you want to look at your inflation indicators to decide how much you might want in inflation hedges as well as how much you want in growth. And then you'll reduce those growth assets as the economy starts to slow, as the Fed tightens policy, as these indicators show a recession might be coming up soon. So follow the Fed policies and follow these other indicators to decide when you want to reduce the extent of growth in your portfolio. And also follow the Fed and average daily earnings to decide when you want to increase and decrease your inflation hedges. So it's pretty simple to use these indicators once you've determined the ones that work. You start out with your basic long-term portfolio and then adjust the different assets up or down based on what's happening with growth and inflation. Now, when you use this strategy, I don't have an all or one approach. I'm always diversified to some extent. Sometimes I'll be diversified with a bias toward growth, other times with a bias against growth, but it's rare when I'll completely sell stocks or go 100% into stocks. None of this data, none of these indicators are 100% reliable, and things can happen in the short term that even if you're right over the longer term, you might get a point where you're wrong long enough in the short term that you're going to want to sell and reverse your positions. So that's why I don't go on an all or nothing approach. I go with a balanced approach. I found that's working very well over the long term. So again, start with your base portfolio, the long-term buy and hold portfolio, and then adjust that based on what's happening with this data and what the Fed is doing.
So do you think, Bob, do you think we're in a, maybe you're getting to it, but do you think we're in a recession or getting close to one? Everybody seems to have a little, some people say, oh, we've been in it, even though it doesn't really officially in a recession.
Yeah, this is returning back to this cycle that I mentioned earlier, and we're clearly past the peak. Economic growth is nowhere near its peak. A number of sectors of the economy have slowed down considerably. Housing in particular, some others, has been a lot of layoffs in technology. So we're clearly past the peak, and we're somewhere between peak and decline. Growth has been slowing. If you look at the recent GDP data, it's not negative yet, so we're not headed towards a trough, but we're in a period of much slower growth. Inflation is still with us, as I mentioned earlier. Inflation tends to rise even when growth is slowing and even falling. The later stages of the growth cycle tend to be the period when inflation is the highest and the strongest, and that's why we've had this sticky inflation, where the inflation has not come down as much as the Fed and most market observers anticipated a year ago. It's not been transitory. So we're somewhere past peak. We're nowhere near a trough, I think. I think the economy has to slow more. Incomes have to come down, and that's simply to get inflation back to where the Fed wants it at 2%. The big question at this point is, if you recall those monetary base charts where the monetary base spiked up during the regional bank crisis, is the Fed going to decide the regional bank crisis is going to spread? Is it going to be so serious that it necessitates abandoning the inflation reduction policies in order to prevent some widespread economic decline or financial crisis? If that's the case, then inflation will stay high. It will stay well above the Fed's target. On the other hand, this might be a temporary loosening of monetary supply by the Fed. It could be the Fed going to conclude that this banking crisis is temporary and that soon it can return back to its inflation fighting. So that, to me, is the real question mark at this point. Is this banking crisis extended? Is the Fed going to keep reversing monetary policy, pumping up the monetary base in order to prevent banking situation from getting worse? Or is it going to revert back to its inflation fighting? So that's the big issue, and that's why I'm watching the data closely in coming months, keeping close eye on the monetary base, and also seeing how much the tightening we've had so far affects measures like retail sales and industrial production. So that wraps up how I look at the data, how I handle it, how I incorporate that in portfolio strategies. Now, as I said, this is what I use in Retirement Watch. You can get an update on where we are every month with Retirement Watch, and we have a special offer for those watching this presentation. You can get the newsletter for only $20 per quarter. You can see that's a substantial discount from our regular price. And so if you sign up as part of this conference, part of this presentation, then Roger's going to let you have this this special price of $20 per quarter.
Yeah, the special 20th Eagle anniversary price. So yeah, this is our 20th anniversary, as I mentioned earlier today. So that's why we have these great deals. So Bob, why don't you tell us a little bit more about the newsletter? We still have a few minutes here. Tell us a little bit about, because what you get on the 16-page issue every month, and then of course you have the weekly updates too.
Yeah, Retirement Watch, it's much more than your typical investment newsletter. It's really a broad-based financial advisory. I cover all the financial issues that are relevant to retirement. Investments, of course, but also estate planning, income taxes, annuities, long-term care, Social Security, Medicare, pretty much anything I can think of that affects your retirement finances, whether you're planning for retirement or already retired. I cover in retirement, and I cover the issues in some depth. I don't just skim the surface and tell you to go somewhere else for the real answers. And I also provide independent, objective research. I do a lot of my own research. And I also know which people who publish are objective and independent, and which are biased one way or another. And I can use that to decide whose results or recommendations to look at and bring to you. So it's broad-based. You're going to get a lot more than just investment advice. You're going to learn how to get your estate plan in order, prepare things for your loved ones, reduce your income taxes, convert that retirement nest egg into a steady retirement paycheck, things of that nature. Also, each week I put out a email. I also post on the website. It's called Bob's Journal. And it's just additional research and insights that I think is going to be very useful for my readers. I don't have time or space to put it in the newsletter, but it's still something that's either going to continue a discussion I had in the newsletter, or it's other information that's going to help improve your retirement finances and supplement what's been going on in the newsletter and give updates between the monthly issues.
Yeah, and one thing that Bob does great is a lot of people out there think, oh, I've done my estate planning, I can just let it go. I took care of that, years ago. Well, the problem is that the government keeps changing the rules on you. New laws get passed. Those things that used to be good strategies aren't anymore because, again, the government's coming after that money. So Bob makes sure that you're always on top of all those changes, and that's why it's so great to get Retirement Watch. That's why we have so many subscribers and a tremendous renewal rate. Once people get Bob's advice, they don't want to leave because they find it so important. I mean, especially $20 a quarter, you find one thing that saves yourself thousands of dollars on your estate. It'll be the best $20 per quarter you've ever spent, and you can click the link in the chat box to get that special $20 per quarter offer. And we still have a couple minutes, Bob, so tell us a little bit about your different investment portfolios that you have in the newsletter.
Right, I have different portfolios for investors with different goals, different levels of risk. I have it ranges from the sector portfolio, which is the more aggressive of the portfolios. It'll be a little less diversified than the others. We'll look for some more narrow opportunities than perhaps in the other portfolios. And then it goes from there to balanced income growth. I also have a retirement paycheck portfolio, I call it, for people who want primarily income from their investments. They want to be living off the income, and then hope to get some capital gains for the rest of the portfolio. I initiated that portfolio back when interest rates first started to get low, when people could not get a decent income from traditional retirement investments like CDs and treasury bonds. And so we needed to expand the investment universe and find ways where we can get a decent yield without taking a whole lot of risk. Many people look for higher yields. They get too much risk. They get highly leveraged investments or something of that nature. And I also have a trading portfolio I call Invest with the Winners, where we just to go into one exchange traded fund each month. It's either in one fund or it's in cash. I look at several models that try to measure which ETF from a broad group I track, which one has the strongest recent returns and is likely to maintain those returns for at least the next month. And it's had a pretty decent track record, but it certainly is capable of going all to cash when markets turn down. It did that a lot recently. And it's also been in gold for an extended period of time recently and in commodities. So it did well in those trades. So those are my portfolios. You pick out the one that does well for you, meet your needs. I also have what I call true diversification, which is a long-term buy and hold portfolio, which does better over the long term than traditional 60% stocks, 40% bonds portfolio, because it's more diversified. A number of my readers will follow more than one of these portfolios. They'll put a big part of their assets in the true diversification, have that be buy and hold, and then they'll make tactical changes by following one or two of the other portfolios. So it really is appropriate for many different types of investors, and you can find whatever investment approach best suits your situation.
All right. Well, thank you so much, Bob. And yeah, to sign up for full year retirement watch for only $20 a quarter. Again, our 20th anniversary special. You get the 16-page newsletter every month. The first 8 pages are about the estate planning and all the retirement planning, and then the second 8 pages is all the financial portfolios that Bob just talked about, and his weekly email hotline as well. So click the link that's right there in the chat button, the chat section right now. You can click on that and it'll take you to the special $20 per quarter price. So thank you, Bob, so much for joining us today. We really appreciate the presentation. And everybody, up next is Bryan Perry, and we will see you in just a couple minutes. Welcome back, everybody, and we're hitting the home stretch. We got 2 more presentations. I hope you really enjoyed today. I've learned a lot. It's been a lot of fun, and we do a lot of things on this YouTube channel, so I want to remind you again to hit the subscribe button right below this video, and that way you don't miss any of our great free content that we have. We update every single week, at least one thing every single week on this channel, and lots of great information. So again, thanks for joining us today. And up next, we have Bryan Perry, the editor of Breakout Options Alert. Bryan, how you doing today?
Real fun, Roger. Great to be with you. Thank you.
All right. Well, I'm going to turn it over to Bryan and let you go.
Okay. Well, everyone, welcome to my presentation here. It's we're going to be talking about my favorite specifics of confirming and trading a breakout pattern in a swirling market where there's the conditions for trading are really much all over the place because we've got, very narrow leadership here and with a lot of things in play with, politics and the debt ceiling and, a number of aspects with the Federal Reserve and interest rates and inflation, a lot of things in flux. So it's finding really great breakout stocks is key to success in this market right now, especially for traders. And just about, and even for investors out there that are looking to, have confirmation that what they're buying is something that they can determine to hold for a period of time, whether it's the short term, and immediate term, or even longer term. So breakouts are important and paramount to what you want to do is establish a really significant buy point or entry point, if you will, and knowing that you can have confidence in that trade and with the idea that your downside is limited because of a number of indicators that confirm that trade and that breakout pattern, and that they feed on each other as the trade matures. And so with that in mind, one of the services that I oversee is what is called Breakout Options Alert. And, hence the name. Breakout Options Alert is based on buying longer term options on big name stocks. Stocks that normally cost a lot of money for people to buy if they want to buy a basket of them. These are the biggest names in the tech patch and in healthcare and some of the aerospace and defense and some of the industrials. And most of the stocks that are leading the market are trading well above $100 a share, some $200, $300, $400 a share. And so therefore to be a part of that small, elite party of stocks that are leading the market, it behooves a lot of people to say, I can't tie up, I don't have that kind of capital to tie up because it's got several $100,000 to even, buy into 100 shares of each stock. So what I do is I design the service to have people buy long-term options that are, they give you the opportunity to leverage those big names and be where the big money is, because, you really, in this market, you want to follow the money. Like in most markets, you want to follow the money, but we don't have a really broad market right now. We've got a narrow market, and it's led by big companies that institutions trust. And so therefore we want to be where the action is and be where the fund flows are. And that is one of our indicators I'll get into is money flow, but that's just the market we're in. And at some point in time, it'll broaden out. But in the meantime, the money is most where the most attention lies in the biggest names. And so therefore, if you're going to be in this market, you got to be where the money is. And that involves, using long-term options to your advantage, because when you do that, then, you can define your time and you can define your risk. And that's what we find to be a very, very successful combination in a market that is very determined. It's resilient, but it's being resilient because it's being led by 20 stocks. So getting into that I'm going to show you a chart of Alphabet Google, and we're going to go through some of the indicators that I use in which to determine to confirm a real good breakout. So we're seeing this is a 1-year chart of Alphabet here, Google. And really with the onset of AI, which is all the buzz right now, that's all the rage. So we already know that there's a theme out there that big money wants to glom onto. And so therefore, I want to be where that attention is, where the focus is. People in this business, professional market participants, they want to have some kind of AI exposure, and they don't want some second or third rate name. They want to be, whether it's Microsoft with their GPT, Chat GPT, or whether Google now with their Brat rollout here, and other big names that are involved, like NVIDIA is making chips, for AI. So Bard, I'm sorry, Bard is Google's AI, and so there's as this whole sector unfolds, the AI sector here, it's going to be a big story going forward, and it's just getting into the early innings here. So, but again, you want to stay with the big leaders that have the resources, the horsepower from the standpoint of financials, the talent, and they can acquire good companies. Just like what Microsoft did, they put $10 billion into OpenAI, and now look at them. The stock is raced higher, with Google now starting to play some catch-up ball. But as we can see, there's a big breakout taking place here in Google, and it's vaulted to a point here where it's made a big extended move. But let's see how that was confirmed here by looking at some of our indicators. When I look at the things that I like to confirm is certainly volume. Volume is the number of shares traded in a given period of any time slot that you're looking to trade through. Now, volume can confirm a breakout by showing increased buying or selling pressure when the price moves beyond the support of a resistance level. And in this case, that's what we're seeing here. A high volume breakout indicates a strong conviction to the market and a higher chance of continuation. And we saw this big breakout right here. There's a big volume indicator right in here. And then boom, you saw it was followed through. It coincided with this big move up from really the 103 area, 104 area up to the 117 area in just a matter of days. So this is an exceptional breakout here. But it's one of these stocks that was building a great basing pattern in here, putting in a series of, it held this nice support line, and then came out of this channel and exploded higher on volume. And so volume is the lifeblood of any big stock movement here. And what I know is that, this will probably, if the stock back and fills, then you're going to see it probably hold this roughly this 110 area here, probably pretty well here. And I'm sure there's a trainload of money looking for a pullback in the stock to buy it in that range there. Another one that I'm a big fan of is this is a money flow indicator, okay? And money flow is calculated by averaging the high, low, and closing prices and multiplying by the daily volume. Comparing that result with a number of other previous tells, traders can tell whether money flow is positive or negative. And we want to see this money flow line consistently moving up when the stocks are making, like you can see the big move here in Google earlier, money flow took off, pulled back. Look, when money flow pulls out of a stock, the stock pulls back. It's a wonderful indicator to help guide your trades, from a standpoint of a breakout. This breakout was associated with rising money flow. So again, we have confirmation here, and we have confirmation here. Thirdly, stochastics is a mathematical oscillator, and you can either use a slow stochastic or a fast stochastic indicator. In this case, this is a slow stochastic, which I find to be a little bit better for my longer term trades, because I'm looking in Breakout Profits Alert, I'm looking to hold these trades on an average of around 3 to 5 weeks. So those are what we call directional trades. And in this kind of a market, which is really choppy and range bound, you've got to give trades a little bit more time to work for you. So in stochastics, we find this to be just a really good, a good way that it basically, it measures momentum, near-term momentum. And so this is one that I like to use, because if you can catch these, if you look down here where the stock was trading at the low end of its trading range, the stochastic was trading right around here too, right just below its halfway mark. So you want to try to, this gives you a nice indicator of where to buy, but it also gives you a nice indicator where to sell. And as you can see, after that big move that came off of this low here, up in here, your stochastic reading was way up, it overshot the top line. That is usually a sell signal near term. And then we saw the stock back and fill coming back down here, and then putting in a kind of a double bottom higher low formation here, which is a nice thing for any chart pattern. But then we saw now you're getting up in here into the sell range area here, because the stock has made this exceptional move. Okay. So again, we want to, once again, it confirmed the breakout, but these are now, now you're already starting to see some of the volume is slacking up in here in the last week, because, you've got some people up here that they don't want to chase it. Big money got in and they're holding it. They're hoping it stays, but you know what? This is where you start to see a stock that's starting to get extended. Now, the MACD would argue that there's still more room to go. Now, MACD is that's called a moving average convergent divergence, and it's a trend following momentum indicator that follows the relationship between two moving averages at different lengths. Okay, and so it's got two moving averages in here that it's following, and this is really what I like to see is a breakout is accompanied by a positive MACD value. Okay, and this is starting to confirm this breakout just as in here. This is a confirmation up in here and in here and in here, going and back in here as well. And these are all associated with the moves here, move here, again here, and here, here, and once again here. And so that's where we want to use MACD, because once again, if you're up in here, then you're probably overbought. Up in here, you're probably overbought. This would suggest that Alphabet has more room to run, but it's of the three indicators we've seen so far, it's the only one that doesn't look overbought. And then coming into our next one is called relative strength indicator. And our relative strength indicator is a pure momentum indicator, okay? That measures the speed and change of price movements on a scale of 0 to 100. And as you can see right now, our relative strength indicator is up to 73 and change. Okay, so it's getting up near the high end. It's a rare occasion that you get to see an RSI reading at 100 or even 90. Okay, this is very bullish at this point in time here from the standpoint, but it's again a relative strength. You know, it indicates that a breakout has happened, and that's accompanied by a reading above 70 that says this is a confirmed breakout, and we have a reading above 70 right here at 79. So we know that even though the stock is overbought, the give back and pullback is going to be probably very mild. And so therefore, this is only going to bring in a lot more money along the way with this trade. And it's just it's the same thing in going the other direction too. When stocks break down, they'll have these indicators will be going the other way. Now with Google here, the reason why I find this to be exceptional is because they had a pretty good quarter, and they have a pretty a very strong business in search, and the ad spend business, which was suffering here back last year, has really started to pick back up. And we've seen that true with Meta platforms also, and a couple other of these stocks that depend on ad spend. So again, in this market, these are just some examples of technical indicators that that are used to confirm breakout patterns in stocks. And these are what I like to use very much. I also, use these opportunities, to take profits, because when I see the volume start to kick down here, and it's not staying up in here and pulling back, and I see this one looks over, extended. This looks extended here. MACD is not extended, but RSI looks very extended. Here's what I like to do, because we're in the trading business. This is for investors. This you can just buy and hold this position here. But for breakout profits alert, we booked that profit. Okay, we came in on March 29th, and we bought the Google September 115 calls, and we paid $8.80 per contract. That's $880 per contract. And then on May 12th, last Friday, we booked that gain, and we came out of those calls at $18 per contract, or $1,800 per contract. You subtract, your cost basis of $880 a contract, and we booked a 104% gain in that particular breakout trade right here. And I say this because I'm very excited about seeing the stock come back down to this 110 area here, and then rebuying this position back. Okay, and we may go back out to September. We may go to October. Normally, I try to buy 6 months worth of time on these options. The further you go out, the more expensive these options are going to be. So you have to be, you're buying out of the money, but you want to buy plenty of time in case the market gets, rocked by something like the community bank problem here, the regional bank issue, or you have, there's brinkmanship going on with the debt ceiling. You have a lot of stuff that the market can get derailed by. But when you have a stock that's on its, basically in its own stealth bull market now because of the AI revolution, then it gives you a very exciting, what they call, just it's a market of stocks and not a stock market. So there are stocks that are hitting new 52-week highs every day. But for our purposes and for the kind of market that we're in, I want to be in big cap tech along the way. And we've had some in our service here and other big names too. Like we're long names like in Boeing, which has a major breakout in last year. And now the company is back on its way making planes by the plane load. And we're just seeing a very strong order book now for Boeing. We recently also went long Amazon.com. Also, they have their own AI program that they're unleashing now, and the stock is breaking out. Applied Materials, they just came out with another process. They're the biggest 800-pound gorilla in the semiconductor chip equipment space. And from there, we look for, again, those types of confirmation that give us, not only a fundamental reason to buy the stock, but also all these technical reasons to buy the stock. I love to see a stock break out, be a part of that breakout, and then be able to buy the big pullback. And then it's just a wonderful thing to be able to trade these stocks all year long, the same names, because you get into the rhythm with the stock, and you know that the rest of the investing world, the institutional world, is buying these names on any pullbacks because their earnings are there. They're the leading. There's no bigger leader in retail than Amazon. There's no bigger leader in search than Alphabet. There's no bigger leader in semiconductor equipment than Applied Materials. I want to be in Microsoft. We had a confirmation breakout in ExxonMobil, and then we just recently had a pullback in oil, and that position is pulling back on me. But I'm in the biggest and best name in the business in Exxon. So when oil makes another run here, and I think it will because we're coming into the summer driving season and the heating and air conditioning season, we're getting into a higher demand season for oil and gas. So I think you'll see Exxon make its way back toward 120. And then consumer staples. This market's it's functioning on big cap tech, healthcare, and staples. Those are the three main sectors that are getting it done in people's portfolios. And a couple names like McDonald's, just the quick service restaurants. Very few stocks are really busting loose. And some of the big pharma stuff, like Eli Lilly. But we've got Procter & Gamble we just put on. That was our latest trade. Procter broke out. And so we have these wonderful big names that we can still make a lot of money in this kind of a market, just chopping people portfolios up left and right because they're in a lot of second and third tier names. And that's just not where this market is right now. So when we want to make sure that we go into, and here's the best part, we're just coming off the end of earnings season here. So you get a chance here to kind of look under the hood. A lot of good companies reported they beat on the top and the bottom line. In fact, 3 out of 4 companies are doing that, but their outlooks are more guarded and cautious. And those stocks are getting hurt. Even though they say, man, they had a fabulous quarter, but the stocks are pulling back because they have they basically are giving lower guidance or they're giving a guarded outlook. And the market is, there's no mercy on those stocks that are even thinking of putting that kind of commentary out there. And that's it, that's the market that we're in because there's this overriding fear of recession or hard landing. So it's imperative that if you're in this market now, and I implore everyone that's watching this workshop, just to stick with quality and make sure that the numbers are in. You're not buying in front of earnings and getting hooked on a hey, great numbers but bad outlook, poor guidance, and then you're looking for these indicators like I just showed you to have as your tools in your technical toolbox in which to confirm these breakouts and not overpay for stocks. Someone up there is buying Google here at 118, when we sold it, okay? Because my indicators are saying we're going to get a second chance and we're going to try to stair step this stock all the way up. I'm looking for a higher low, but I'm also looking for a new higher high. And stocks cycle like this. They either cycle up or they cycle down. Unless you just get a trapdoor sell-off because someone completely, misses their whole business model. So with that in mind,
let me ask you a question, Brian.
Go ahead.
You talked about several indicators.
Yeah.
And an example you gave, I think it was 3 out of 4. We're definitely showing it. Do you have a favorite indicator, or are you looking for several of them to kind of confirm with each other?
Let's go back here for a second, Roger. I think in here, when we're looking at all these indicators here, my favorite one for the near term is the stochastics. This tends to give me, well, I guess I'd have two. It would be the high volume reading here, because that really is confirmation that the institutional money's coming in. But I also want to see this indicator just turn. I want to try to buy them right off these pivots, right off the V bottom here. Okay, this is really helpful here. This is kind of a trailing. The RSI is more of a trailing indicator. This is more of a leading indicator. Okay, and money flow is just as important too, but that's also tends to trail. This is in real time volume. Okay, so we want to have real time volume, and then these tend to be react to the volume. Okay, blow up. When volume blows up, but stochastics tend to give you direction. It tends to lead. It tends to point where the puck is going and not where the puck is. Okay, using Wayne Gretzky language here.
Right.
So those are the two I like, Roger, to more or less say, aha, we've got a breakout here. Overbought. Okay, I've got volume, but I've also got room to run.
Gotcha.
Yeah.
And I think what's important for everybody out there is, this is how the sausage is being made, and it's being made. You guys don't have to know all this stuff. It's great to learn about it. But you can just let Bryan do it.
Well, I'll also say this too, Roger. We've got I've got 2 AI programs that I plug all this stuff into, and it really helps to be able to again give me a reading above 85 to 90 to 95, whether these trades are being confirmed through. And that AI indicator has 16 different components to it. So these are just the favorite 5. These are the ones that people kind of have some familiarity with, and it's just but the others are just a lot of different things that are very specific to trades, and you can kind of get confused by it. You can get a little bit of overkill on this whole AI thing. But if you have a program that's designed for specific trading, like mine is for 22 days. That's what it's set up for, and that's 22 trading days in a month if you knock out all the weekends, right? So that's where that program is designed for, and it does help me a great deal, because these are 5 of the components in there, but there's roughly 10 or 11 others, and I just look for kind of a majority, if you will, in the boardroom of indicators that are saying, yeah, raise your hand if you think this is a great trade, and when you do get confirmation by several different many different indicators, then you can go into a trade with confidence. And also know that, hey, if something does happen geopolitically, and all of a sudden Google trades back down, under here, well, you can still sleep at night, because you're in the best name in the world in what they do, as opposed to being in something where you're just really not sure about the business model and all of that. Because there's always some lily pad you can jump to, from lily pad to lily pad in this business of trading. But really get to know a stable of really great stocks. And because they're expensive, because this is a $120, $118 name, it might be not that affordable for people that want to say, I just want to own, I don't want to own, I can't own all these stocks. I can't own Boeing at 200 and Amazon at 110 and Applied Materials at 120 and these other names, and Exxon's up there at 115, Procter & Gamble's at 180. So, but I want to own that basket. And so therefore the breakout profits alert. And hey, guess what, guys? I think our special for this particular show is only $20 for the first month. Is that right, Roger?
That's right. We have a bunch of 20th anniversary of Eagle Financial Publications offers today, and yeah, $20 for the first month. So you can test.
So guys, this is a no-brainer. Especially if you get a trade like this where you're already off to the races. And once these few of these storm clouds clear, meaning the Federal Reserve, they're either going to, right now there's only a 12% chance that they're going to raise another quarter point. 88% of the big money out there thinks they're going to pause. And so you've got that, you've got the Biden administration say, in no way, no how are we going to, default on our debt. No president wants to have that on his watch. No way. And so there's something going to happen there that's going to be It may come up to the midnight oil, but where they burn that oil, to get it done, but it'll get done. And then, from the standpoint of inflation, we just had two very, bullish inflation readings here, the lowest inflation reading since last June of 2022. So inflation is trending in the right direction. It's not as fast as everybody would like, but it's trending in the right direction. And we didn't have an earnings apocalypse, which everybody thought we were going to have in the first quarter. And so with that in mind, earnings came out pretty well, but the market's still very skittish. Okay. And coming into the summer months here, most of the money is going to be made in the same big names, I believe, because they gave very good outlooks for their business models going forward, where a lot of small to mid cap companies were kind of, with this banking crisis going on at the regional level, there's going to be a bit of a credit crunch here for a lot of small companies that need to get their lines of credit, or they'll be paying a lot more money for it, higher interest rates. So, but these companies like Alphabet with a war chest, they're not borrowing money. They're outside that system. So again, play it safe, but you can still leverage this kind of behemoth type of a stock and behemoth kind of a company by using long-term call options. And I put those together for you, which is going to give you the best risk reward for your particular money on this trade. And in this case, we had the stock move 10% and we made 100% on our money in less than 6 weeks. If we can repeat this going forward during the course of the year, well, then just do the math. Okay. And we're going to try to make that happen with like 6 to 7, 8 names on a steady basis. So, who wouldn't like a steady diet of those returns? Well, but again, this is what happens here. You can spend some time doing this, or you can get that trade on as it's just about to do this. This is time spent making nothing, but this is time spent making a lot of return on your money in a very short period of time. So that's the basis of this workshop today. I live and breathe this breakout mentality, because I don't want to have my money not working for me as much as possible. I want to have 7 to 8 different, what I call stalking horses in there, always, pulling the wagon of total return. And with that in mind, Roger, I think that this is really, a service that a lot of people can use, because it does camp out in the big names, but it does so in an affordable way that people can make exponential returns for nominal, for mainly a conservative move. A 10% move that generates 100% return is about as best of all conditions in this kind of market that I can imagine, because you're not in some penny stock or something that that has a very high PE ratio with no earnings, like a lot of the Kathy Ark stocks and things like that.
And like
that's
you
about
said,
where we're at.
Yeah, and like you said, the options are a lot cheaper to buy than buying the stock, so you're not putting as much money at risk. But when you're getting 10 times the return, you're having your cake and eating it too, really.
Well, that's that is by design what we're doing here at Breakout Options Alert, and we've had some really big winners here. But the market, you have to also know that you're not in a screaming bull market here, so you have to take what you can get. And yeah, again, you're back up here. If you look over here, this is also, you have to respect that we're in big money that's still in, Alphabet up here, and went through all this choppiness and this correction. They're now able to get out at break even. And a lot of big money will elect to do that, or they'll sell a bunch of covered calls up in here and hedge their position. But this money back here is like, okay, now I can either cut bait and walk away from this trade, or I can see if there's more to go. But that there's going to be a lot of big money questioning whether or not they should stay or go. And so when I see the stock run back up into what was once support down here, is now resistance up here. Okay, this is what they call a dual resistance support line. This is your range. These are your Bollinger Bands in here too. I didn't really get into the Bollinger Bands because that's more of every stock trades within a range, and these Bollinger ranges. These are usually 20-day, ranges. And so when you have a stock that breaks above a Bollinger Band, in this case, we saw this big breakout above this Bollinger Band here. That again is another confirmation of a legitimate breakout and not a false breakout. Okay, so you didn't see that confirmation here, and look what happened. You had this. You didn't see it here. Look what happened. Came down. Tried again, failed. Tried again, failed. Tried again, failed. This time, this Bollinger Band is chasing the stock higher. Okay, and so another way that we can just say this is a very good, and a lot of people trade off of Bollinger Bands, but I tend to there's a lot of money that can be made inside the bands. Okay, unless you're in a raging bull market, you're usually okay. Then you can stay with it. But in this kind of a market right now, where the S&P is in a 200-point range, as is the Nasdaq, as is the Russell's actually in a bear market. So we want to respect the trading range, but you can make good money in the trading range, But it's not a buy and hold market per se, unless you got a few stocks in there that have done well, that have a life-changing story like Eli Lilly and their Alzheimer's drug, which is also their obesity drug, and the stock is really ripped higher. And if that stock comes in, then I'll be looking at that too, because there's who knows how high that stock can go based on those two drugs alone. But in here, and then also again, moving averages. I'll stay with this. Moving averages are important from the standpoint that all algorithms out there, and bear in mind, guys, that 70% of all stocks traded today are being traded through high frequency trading shops, what we call prop shops, proprietary trading shops. And it's important that you respect that, because when these lines are violated to the upside and downside, in this case, this is your 20-day moving average here. The yellow line is your 50-day moving average, and this big black line is your 200-day moving average. So when you see the 20-day and the 50-day move up through the 200-day, that's called a golden cross. Okay. And the longer term chart here I don't have up, but when the 20-day and the 50-day move down through the 200-day, that's called a death cross. And a lot of people on this call, I'm sure, know that. But we also have confirmation here, because we saw this golden cross established when this 50-day here finally came up through the 200-day. And then you saw this breakout confirmation by not just all these, down here, these indicators, but also through the trend lines, and the stock held the 20-day and then got some confirmation through the 50-day. And then for the rest of these, and then you got the number one confirmation that I got here on the upside volume that's like you're getting a transplant of fresh blood. Mm-hmm. And so, we want to be in that transplant situation all day.
Well, and the other thing about Breakout Options Alert is you don't only make money on the upside, because there's money to be made on the downside as well. Yeah. And, everything you just talked about on the bullish side is really pretty much just the opposite. And then to go short, right?
That's true. No, we've had a few good trades on the downside, because the market is it tries to be optimistic. Even like right now, a lot of people thought the market would be back down to 3,300 on the S&P 500. You've got a big bear camp out there, and yet these indexes are holding the market together. So it doesn't mean that we can't make money on the downside. We can. And, I'm constantly on the lookout for a big type of stock that's overowned. They call these crowded trades, Roger, where you got a big crowded trade, a lot of people are in it, and the stock falters. Well, it's like, and the one that comes to mind would be Pfizer. Okay. The stock is breaking down to like new 5-year lows right now in a market that, is anything but. So, but that's been a steady grind lower. It's not like it's a complete breakdown, but with COVID now moving away, they were a big player in that, but their general business model has not performed well, even though they make a lot of great products. And so I look for something like that. And I generally am, try to find bullish patterns, because I know that that's also what most money managers are trying to do. The shorts are they're very quick to take their profits. Okay. And there's a lot of rumors in short stories here. You got to be very careful that someone's just not, touting a short position by spreading bad news and rumors. It's a more difficult game to play, if you will, on the downside. But if there's something that's a fundamental breakdown, because Tesla is just now dominating, and it looks like they're going to, continue to dominate. Well, then some of these EV companies that are trying to compete with them, they may not make it. And those would be more of a core short out there, in terms of trying to go up against the beast. And it's true in any business. If some of these drug companies that have a lot of big drugs coming off patent, and so if they don't, they're going generic, and so if they don't have something to replace that, then that's also a good place to find good downside opportunities. And I think that that's something that we look for also. Is those are big linchpins for these companies out there. Other things that are more like, in the banks right now, even if you're in good regionals like PNC or Truist and these other big names, as you come up to the end of the quarter, big managers, big portfolio managers, as we call them, PMs, they're not going to want to have a lot of these stocks on the books when the quarter comes, because they have to post their results to all their institutional clients. So you get into the business of window dressing. And so therefore, when it comes to that, then you're basically what do people want to get out of before their report card comes out, and they got to show what they own at the end of the quarter. And so there will be some opportunities here to continue to sell banks into strength, because there's little reason to find a catalyst, for that sector right now, but they're already down quite a bit. And so therefore you got to be, again, you don't want to chase stocks higher, and you definitely don't want to chase stocks lower, because if something magnificent comes out of the FDIC that says it's a bailout package of some sort, then this whole sector could get in a big short squeeze. There's nothing worse than being part of a short squeeze if you're on the wrong side of that trade.
Yeah. So breakout options alert.
It's great if you're long. But...
Yeah, exactly. So on breakout options alert, just to let everybody know, again, Bryan's just gone through all the stuff he goes through to educate you. We're always about education here at Eagle. We think an educated investor is a better investor. So you can learn all that stuff, or we make it easy in Breakout Profits Alert. We send out an email and a text at least once a week, and we update you on the positions we have, many new positions, and then of course throughout the week, if we have a sell because we're taking some profits, we'll send a quick alert out and just say, hey, we just hit 100%. Let's take the gain, let's take the money and run. So it's very simple. It's a simple strategy. There's a lot of option strategies out there that get complicated. This is simply buying a call or buying a put and then selling it. It's the lowest level of option, trading on the, from your brokers. So, it's easy to get that account. And we make it easy for you, read it, do exactly what Bryan says, and it takes you a couple minutes every week, and you're in and out, and you move on with your life, and so it's been a great service. We just launched a couple of years ago because we really realized that the market is going to be choppy, and this type of product was perfect, and it's still, look at that Google chart. It's so choppy, but yet here, we're making 100% gains in it. So as Bryan mentioned earlier, we've got the special $20 for the first month. This service is normally $1,995 a year, but $20 for the first month. You can try it out. There's a link in the comment section that takes you over there. You won't find this offer anywhere else. You got to click that link to get the $20 because it's a special 20th anniversary for Eagle that we're giving, these offers on today in this YouTube live event. So, and after that, it's not going to be $2,000 a year. It's $275 a quarter after that. So still a significant discount. But the $20 gets you in. You try it for a month. We're giving you $20 because we know that you're going to stay on. $20 we're not making any money, but we know that you'll stick with it, and we want to give everybody an opportunity to see these products. So, so that's where we are. Any final words, Bryan?
Well, not every trade's going to come out like Alphabet, and it's important that you have someone that helps you guide you through these trades. Because you do get we're in a headline driven market that there's a lot of headwinds and headline driven, and also where there's a lot of headwinds. And so when we get into trades that are moving sideways, then you have to understand when it's also the prudent thing to look for opportunities if it looks like the trade's not working. A lot of people just let these trades fizzle and then they get into trouble. So you should have perspective on a timeline as to when it's important to understand that your trading capital is managed properly. And sometimes you have to manage the damage because you will get a bad headline or two, and then you got to do something about it. But if you know that this if the sector's okay, but and the tide's not going out, then that's one thing. But if you're swimming against the tide, you may have a great stock, but if you're in the wrong sector and the tide's going out, then that's not a place to be either, no matter how good it is. So it's important that that's just another form of confirmation, is to make sure that the market's favoring the sector that you're in, and you're just not on a great baseball player on a lousy team.
All right. Well,
how that
Brian's gonna make sure you're on the winning team. And again,
yeah, exactly.
Click that link in the comment section to get breakout profits alert, breakout options alert. I'm sorry, breakout options alert for just $20. And thank you, Bryan, for your presentation. Yeah. Great stuff. And we will be back in just a couple minutes with Hugh and Aaron from DayTradeSPY. So I'll see you in just a couple more minutes.
Thanks, everyone.
welcome back every day. It's been quite an event all day today, and we are at our final presentation. Hugh told me that I saved the best for last, but I can't say that because that'd be like, picking my favorite child. So, but anyway, we're getting ready to have Hugh Grossman and Aaron Stevens talk about DayTradeSPY. But first, I want to remind you, subscribe to the YouTube channel, hit the subscribe button right below this video. We have new content every week. We have some new things in the plans to get even more great information. It's all free, so subscribe now so you never miss any of our content. So now with that, I'll turn it over to Hugh and Aaron. How you guys doing today? And I'll let you take it away.
Great, thank you very much, Roger. If I can speak for Aaron, I think you're our favorite dad. So
Yeah, definitely.
okay, well, hi everybody, and let's get started. And let me just share the screen here. Here we go. Look at that, through the technology. I think everything's working just fine. I take it you can see my screen okay? Let me
Yep.
see. Good. Okay, good. Look, you know what? I don't have to tell you, ladies and gentlemen, just check the headlines and the news every day. We seem to be in a lot of chaotic times. And frankly, I have no idea where the market's going to go a year from now, enough to put my life savings on it, or even a month from now, or even a week from now. But Aaron and I got a pretty cool thing going that we have a really good idea as to where the market's going to go today and tomorrow. So with that, we were able to monetize that and make some money on the stock market every day. So this is all about day trading SPY options to prosperity in both good and bad times. It doesn't matter. So my name is Hugh, and I'm just going to introduce ourselves here. First, here's the disclaimer, and I think you can read that. Aaron, you're a speed reader, so I'm sure by now you've already read that. All you have to know is you are responsible for everything. We're responsible for nothing. And with that, all right, so we're going to introduce ourselves to you real quick. My name is Hugh. I'm the guy with the dog, and she's the love of my life. Folks, I got my training in the trenches, deep in the mud, training with options, and been doing this now for a long time, since 2010. That's when people started to coerce me into showing them what I'm doing. And it's just been great ever since. I've been loving the teaching aspect of it. And we're looking for short-term breakouts. Just get a little bit of money every day, stack it all up. At the end of the day, walk home with a little pile of cash. That's kind of what it's all about. And this is Aaron. He's the good-looking one, folks. No, he's the smart one. I'm the good-looking one. Aaron, all yours.
Yeah, well, my name is Aaron Stevens, and I'm happy to be a part of DayTradeSPY and Eagle Financial Publications. And thanks everybody for coming today. I got my start back when I was 13 and opened up the Wall Street Journal and started going through the quotes and the tickers and making lists and looking at price quotes. I opened up my first trading account when I was 17, joint custodian account, and my own account when I was 18. I ended up getting a little bit burned in the stock market bubble. I took a break, but I came back strong about in 2006, 2007. I started, learning everything that you can about the basics, fundamentals, and creating a strong foundation in technical analysis. I read, several books and just spent hours and hours looking at the charts and testing different strategies and different patterns. I ended up working, studying on my own for a commodities license, a Series 3 exam. I worked for several firms, and then I ended up working for most recently a commodity pool operator operation here, which is had about $150 million under management at their height. And so I was the main analyst after the head trader. And yeah, so, Hugh says that he got his experience in the trenches. I would say I got my experience through thousands and thousands of hours looking at the charts as well, and putting in a lot of time and effort. And I'm happy to be here.
Right. And I just got to say, Hugh, your dog's name is Lucy. I think you two in the audience will love the name of my dog because his name is Cash.
I love it. Why am I not surprised? That is so funny, Cash. Yeah. Now, Lucy and I go way back. She's my boss, let me tell you. All right, gang, this is what the session is going to cover here this afternoon. We're going to give you a bit of an introduction. Why SPY? Why now? Why DayTradeSPY? Why wow? This is it. Look, you know what? We don't care about all that other stuff. We just want to make money. How cool is that? Because when you make money, you can do a lot of things with it. And obviously, I don't have to tell you all that. But I also have a basic strategy you can use right now to get some very modest but consistent gains. And now when I say that, I do want you to understand there was a disclaimer with that I just showed you. So nothing is ever for sure. Just so you know, there are never any guarantees in this business. But we've got pretty well everything covered here. And then we're going to show you, again, it's just a brief overview, right? Just a big thing that we're doing here to kind of give you a primer on what we're all about, what SPY is all about, all that other wonderful stuff. Aaron's going to go over with this deep dive analysis to give you some enhanced confidence and profits. And when our indicators unite, our trades ignite. That's the model we use. And it just seems to work extremely well. Then we're going to give you the next steps in becoming an expert trader. Because the way we see it, if you can be the expert, you don't need everything else out there. You don't need anything else. This is it. This is it. All right. So why SPY options? I think this is the best choice for today. So what we do is we day trade options, stock options on SPY, period. That's all we do. We don't do anything else. I don't care about anything else. You can talk about Apple and Google and Microsoft all you want. It doesn't impact what we do. Okay. So why SPY, you ask? Well, here's why. First of all, it is the stock that tracks the S&P 500. So what it does, and there's a lot of things that sort of involved with that. You know, to be in the S&P 500, you got to be a good company. You got to have a market cap of 12.7 billion, U.S. based company. You have to have all these requirements. But what I like about it is that it's diversified and has a lot of stocks in it. Now, actually, there's 503 symbols because some companies have more than one symbol, like Google. But so we have all of these companies in here. That is the important thing about that is that no one company has so much power that is going to influence the entire sector, the entire exchange traded fund, I should say. The highest weighted stock in here is Apple, coming in at 7.28%. So if Apple went completely broke this afternoon, that in and of itself should not completely wipe out SPY, if you know what I'm saying. Then comes Microsoft, Amazon, NVIDIA, and all these other ones down the street here. So just listed the top 25. You can see there's a lot of different stocks from different classes, different sectors. And here are the sectors. People ask me, well, why don't you diversify? So, well, I can't think of a more diverse thing than SPY. We've got all 11 sectors represented here. Information technology, healthcare, financials, everything is right here. So this is what's really cool about it. It's also very highly traded. It's nothing to see, 80, 100, 120 million shares of SPY traded every day. I don't know what it is today, but it varies up and down. I've seen it as high on quadruple witching days. Don't worry about the terminology now, but I remember seeing over 400 million shares being traded that day because of the high volume. But the thing is about that is that it gives you liquidity. And I think with that, it's really important because when you buy something, you want to be able to sell it as well. So it's also very affordable. You can see that from this list of high and low, which, by the way, every day you see these kinds of numbers. You see all kinds of amazing ranges in here from 4 cents to $3.40. Look, I'm not trying to make thousands of percent in the option world. I don't even want to necessarily make 100% a day, but can I not make 5 to 10% a day? I think that's probably not unreasonable. It's exciting, very profitable, or you can have boring trading if you want. That's the nice thing about SPY is you've got all these various things that you can do with it, however you want to trade. So now more than ever, I like to trade SPY because you can work from the comfort and safety of your home, work whenever or wherever, as little as you want. I have traded on, ski lounges. I've traded in airports. I've traded in coffee shops, on the beach in Mexico. I've traded just about everywhere. There's no overhead or inventory that you have to maintain, no employees or government agencies that you have to appease. You don't have to go looking for customers. They're there, or try to collect from them. They're already there. You can start with just a little bit of capital. You don't even need a whole lot of money, and the potential is unlimited. The potential is completely dependent on your skill. and how you are able to control your emotions into the trade, and you also get favorable tax concessions, which I truly really like for trading SPY. So there's a lot of great benefits for SPY options. So moving along here, the power of options, you're limiting risk, the moves are quick, and the leverage is huge. And that's what I really like about it. So folks, if you are new to options, and I know that a lot of people watching this are new, they're probably scratching their heads, what is this guy talking about anyway? All I know is buying and selling stocks and equities. Well, first of all, options on your trading platform, you're going to see a little section there, depending on the platform. One little tab might say stocks or equities. The other might say futures. Another one might say Forex or something. And there'll be one that says options. Now, if you click on that, you're going to see a whole new world. And let me tell you, your market is right there, right there. So what are actually contracts that give the options holder the right but not the obligation to trade the underlying stock for a certain price by a certain date? Don't get too bogged down on the terminology. Just remember two names, calls and puts. If you expect the market to go up, you buy a call option. If you expect it to drop, you buy a put option. There's also strike price. This is the price at which the stock can be bought or sold for or exercised, or when it's converted. That's the price. Expiration date. This is the date when the contract expires. And there's this thing called data loss. So it's like buying an ice cube. The option melts on you. All right. The value of the option melts just because you own it. So this is the rate of decline of the value of an option due simply to the passage of time. And then, of course, there's delta, the theoretical estimate of how much an option may change given a $1 move up or down in the underlying stock. So it's the relationship between the option and the stock. Again, this is just a brief overview. All right, so don't get too bogged down in the terminology or anything at this point. You're not going to miss anything if you don't pick this up. Some pros and cons with options: flexibility, cost efficient, huge leverage, high return potential, many strategies available, and I like it because it's very fun and exciting trading. There are some cons. I'm not going to kid you. All right, and it's not all rosy. You have that time decay you have to consider. You do have commissions to pay, and let's face it, it is risky. Now, the way we trade, you can only lose what you put into the trade. All right. There are other options, strategies where you can lose like a lot, like a way a lot more. So just remember, the way we trade, you can only lose what you put into the trade. And I think that's really important. So SPY, why now? Well, we follow the top 500 US stocks, very efficient use of analysis time. I can tell you that I get in front of my computer at about 8:30 in the morning, and I can tell very quickly whether the market's going to go up or down. Moves are quick. We're not talking about a long, extended time here to get your money, and you can make your gains fast. I like SPY because it's fairly reliable, consistent, predictive, and in a lot of ways, very forgiving. And you can actually forecast the ups and downs in the market fairly easily in this world that we're in here, in this space. Again, note the disclaimer, no guarantees with any of it. SPY, why not? Learn something new, stay mentally sharp, earn while you learn. Time's going to pass anyway, you might as well make money at it. Profit potential, absolutely huge for serious traders. And you can have that dream lifestyle that is truly achievable, folks. Also, again, very exciting, and it's sort of thrilling to beat the market. There's a little something about that, I think. And what I like about it is you can pass this knowledge on to your kids for financial stability. And I can't tell you a more liberating feeling than knowing that my kids have the ability to go and make money on their own, especially in this world. And you know, folks, that there's no guarantees of any future in working for somebody. Right? A job means J-O-B. What does it mean? Just over broke. So you want that financial stability in here. So I'm going to give you a bit of a potential gains comparison here. So let's say I want to buy 100 shares of SPY. Say it costs $414 a share. You're going to invest $41,400. Now you can also buy a contract, an options contract for say $3. That's going to cost you $300 because again, you're controlling 100 underlying shares with each contract that you buy. So if the stock rises $1, you've got yourself $41,500. Now, if that, that option rises, if the stock rises $1, the option is probably going to have a 50 delta, which means your option is going to rise 50 cents. That means your $300 investment just turned into $350. Well, take a look at your return on investment. 0.24% if you bought the stock, not to mention that you have to put up over $41,000 versus 17% on your investment for an investment of $300. You can see the value here. and so can this young lady here. Which would you rather have? I think it's pretty obvious. And here's the funny thing about it. Once I discovered the power of options, I'll tell you, I never traded stocks again. That was it. That's like, I found the one, so, and that's pretty cool. That is pretty cool. So we day trade SPY options. I got to tell you, over the years, we figured out what works and what doesn't work in both trading and training. And I think that's really important because you want to align yourself with a company that understands that whole concept of both trading and training, and so it can facilitate your goals and aspirations and things that you need. So why trading with DayTradeSPY? Well, we have the experience you need, personal support. We've got value pricing in everything we do now more than ever. We're also very approachable. We're accommodating, service to you. We have no hidden costs or agendas, no costly upsells. And here's the thing. We trade what we teach, and we teach what we trade with proven programs that work. I can't tell you enough about it. DayTradeSPY, that's us. We have the experience. Between Aaron and myself, we have something like over 40 years of combined market participation. That's pretty serious. I don't know if too many people who can boast that. And our programs, this is give you hands-on, real-time, real market environment training that works. We have this trading room, but we're not going to talk about that today. But this is where it all comes together. And you know what? It's very cost-effective. You simply cannot afford not to engage our services. We have a lot of accolades that come to us all the time. We can't even, post them all. Just about every day we get these things. So DayTradeSPY, we've got this basic strategy I'm going to tell you right now. You can actually start tomorrow. All right, you can actually start this tomorrow, and very exciting. So pay attention to this. This is a very simple strategy. Even a novice trader can master this. Start with a 5-minute chart. Okay, and I'm using, by the way, TD Ameritrade Thinkorswim. So use the 5-minute chart for the setup. Now that green line is a 10 exponential moving average. You're going to want to install these on your charts. The red line is a 20 exponential moving average. We're going to just track these guys. All right. So here's what you're going to do. You're going to buy when the 10 crosses the 20 on the 5-minute chart. You're going to take a look and watch that. Okay. But what you're going to do is, and of course, there's the line where the stock went. But what you're going to do is you're going to trigger off the 1-minute chart. So when the 10 crossed the 20 here on the 5, you're going to flip over to your 1-minute chart, and you're going to trigger when the 10 EMA crosses the 20 on the 1-minute chart. Immediately put in a sell order for, say, a 6% gain. I got to tell you, the higher the gain that you're expecting, the more harder it's going to be to get it. But anywhere 5, 6, 7%, you should be okay with that. And you can see that this trade was over just in a few minutes. In fact, using this model here, and it could be any day, any time. This happens all the time. The 374 strike price call options expiring the following Friday. We picked up our 6% in just a few minutes. How cool is that? So if you had to put in even $2,000, you'd walk away with $120. That's not so bad in a few minutes, and you can do this all day long. Folks, here's some tips on this simple strategy. First of all, buy the at-the-money options. Now, buy next Friday's expiration for time and your lower theta loss. Now, you're going to ask me, well, Hugh, if we're going to sell it right away, why do we concern ourselves with theta loss? I'll tell you right now, because if the stock goes against you, you really want that theta loss. You have a much, much less theta loss further out. And I find that the best balance between risk and reward is to buy next Friday's options. All right. Immediately put them up for sale. Why is that? A couple of reasons. Number one, if something happens to your computer or your internet goes down, now you're stuck, right? You're stuck with these options on your computer, not on the market. And the other thing is this, you want to have that target price established as to where you want these things to sell. You're not going to get greedy. You're not going to chase it. You want to make sure, okay, I'm going to make this kind of money and I'm going to be happy with it. Aim for that modest 5, 6%. That's all you really need. And be prepared, as options do fluctuate. They don't go in straight lines up or down. They go up and down. They zigzag. And use a good till cancel order. All right, very important, because like I said, if something should happen to your internet or your computer and it goes down, your option will fall off the order, fall off the board, off the market if it doesn't sell that day. This way, it's on the market until it actually sells, or you change it. Consider a repair only if the stock drops 40 to 50%, rather the option drops 40 to 50%, and it sets up again. We have a whole section on that alone, not on this webinar, but a whole new training thing on that one. Also, you're going to want to control your emotions, fear, greed, ego, and FOMO, fear of missing out. And do not overtrade, folks. Stop when you hit your daily target. Very important. All right, so predetermined on fundamentals, triggered on technicals. You're going to stay on course with the psychological aspect of trading. So this is actually really cool. So now what I'm going to do here is we're actually really going kind of very fast here today, and I hope you're picking this up. And if you have any questions, there may be a questions box in there, and Roger might have some questions. I want to introduce you to Aaron's deep dive analysis, but before I do, I want to explain something to you. So I have my set of indicators that work extremely well for these short-term breakout trades. Excuse me. Aaron has another set of indicators which he's going to tell you about, and they work on, well, he's going to explain all that. But when Aaron says the market's going to go up, and I say the market is going to go up, I think it's pretty safe to say the market's going to go up, and you should probably buy call options. So with Aaron's deep dive analysis, extensive technical analysis background, I'm going to hand this off to Aaron right now. So Aaron, all yours.
Thank you. I appreciate it.
All right, before I do jump into you, I just want to say this here. Enhanced confidence when further study supports the trade. Greater gains potential for the initiated and protection from entering the wrong direction. These are all things that Aaron brings to the party. And this is, again, when our trades unite, our indicators unite, our trades ignite. So this is your first slide. You've got lots of time to talk about this.
Well, thank you. Yeah, so this is the same kind of charts that I would present, you know, on the $150 million commodity fund that I worked before, and the same charts that we go over every single morning. So I do want to iterate that before we get started here, is the value that you're getting from working with us is extraordinary, and the value for what you get is really amazing. So you know, every day we start with a market deep dive analysis. At least I do. I look at the daily charts and I mark them up, and I look at the direction that the market may go. I look at market symmetry. I look at the Andrews pitchfork, which is here is in blue. I look for support and resistance areas that are very obvious, and I also look for patterns. So I look where, you know, if the market is touching a Fibonacci retracement area, or if it's near a Andrews pitchfork, or if it's the market symmetry is close. I can kind of predict at those points. That's how we get those 1 + 1 = 3. Is that when we have multiple tools that I use along with Hugh's techniques and strategies. That's how it works when we put when our indicators unite, our trades ignite. So for example, you know, on the daily chart, we had multiple resistance tests at that I believe around the 417 level, and the market's starting to drop a little bit now. And we talked about this all throughout the trading room, and we even go over the daily charts towards the end of the trading room every morning. So this is the first thing I look at when I look at the charts in the morning. I look at the daily and the 4-hour, and then go ahead, Hugh, to the next screen. And we also look at every day. We identify key support and resistance levels, and we look for possible reactions in the market. So here you saw, you know, multiple touches on the 409, 50 to 410 level today, and over the past couple of days. And we talked about this extensively in the trading room. And so, you know, even after you've joined us for an hour, I give all these levels in the trading room, and we talk about them extensively so that you're prepared for the rest of your trading day. So most of our customers, they decide to continue to trade after they're trading for the first hour. Some of them do continue to trade throughout the rest of the trading day. So again, this gives you the understanding of where the buyers and sellers are, as well as you know where institution orders are at. So this is the same information and techniques that institutions use and institutional traders use throughout the day. Go ahead, Hugh. So by looking at these higher time frame support and resistance areas, we then go down to this is actually 1 hour chart. So price shows reaction on strong levels of support and resistance down to the smaller time frames. So one great thing that we've been working on and providing those at DayTradeSPY is having a high eagle eye view of the market and going all the way down to the 1 hour, 5 minute, and 1 minute charts to take those precise entries and those precise decisions to make the most out of your trades. So in this particular example, we're going down to the 1 hour chart, and you can see how those 4 hour and daily support and resistance points really react. We have multiple touches on this chart in different areas, but you can really see how it fluctuates and how they react and how they intersect. So sometimes in the trading room, I think Hugh mentioned in the past, price will be at a level and he'll confer with me and say, what do you think, Aaron? Do we have room to grow, or are we at any major resistance points today? And I'll say, I'll give my read on it, basically using this roadmap of the markets to gauge and to help traders that are with us and to give them advice going forward. So go ahead, Hugh. And so this is another strategy that we align along with the support and resistance levels on the deep dive analysis. So by utilizing the Andrews pitchfork and Fibonacci, we put it all together to combine and make our 1 + 1 = 3 deep dive analysis highly profitable. And this is an example of the Andrews pitchfork, the same Andrews pitchfork that I presented in the trade room, with multiple touches on the middle median line in the center there, as well as the Andrews pitchfork sliding parallels. So, we trade in the way the market direction, and we also look for these higher support and resistance and diagonal support and resistance areas, again, so that you can be confident in your trades and be confident in your trading success, utilizing the indicators in the trading room as well as my analysis. Go ahead. So again, by utilizing the Andrews pitchfork and Fibonacci, we'll put everything together. So this is a particular example of an ABCD pattern. So on the bottom left, you have the 100%. At the top, you have the 0%. Price came down, and we saw and identified buyers at 50% as price was lifting off that level. And one thing that we talk about extensively in the trading room is a very simple pattern called the ABCD pattern. So we both have symmetrical ABCD extensions as well as Fibonacci extensions. And this is a very clear example of a Fibonacci ABCD pattern extension, where you had buyers that came in at the 50% Fibonacci level, and they exited at the 161.8% extension up there around the 415.87 to 417 level, and this is all recent price action and information that you would get by working with us in the trading room. We actually identified this level in the trading room. We talked about how price was coming into resistance and that you might see some profit taking at that point. And again, price just came down, and we even identified the small ABCD pattern to the downside after it touched that 161.8% extension, and we had talked about possible a symmetrical move down into the 404 level, and it ended up hitting that level almost, I believe, it went a little bit lower than 404 in the trading room. And I believe, Hugh, I think it was, I think you were kind of amazed at that call, weren't you? We talked about recently, you said, is it really going to go down that low? And I was like, yeah, I think so. I'm pretty sure, because the symmetry is just very clear. It was actually a 61.8% retracement down to that 404 level in the price action that you see most recently around May 7th. And then price reversed, and we actually caught some of that to the upside as well, and some call options that were in the trading room the following day, which was pretty good as well. I believe that was last Friday, if I remember correctly.
It's pretty amazing.
Yeah, and now currently price is at a sliding parallel. I mean, that's it today, the price action for today. So we're kind of caught in between this range, in between the 404 and the 415, 417 level. And by having these levels on your charts and understanding what I do to give you this information, you're really looking through the eyes of an institutional trader and institutional analyst, so that you can use that information to your advantage in the rest of the trading day. I believe there's one more slide.
One more slide there. Yeah.
Again, so when we combine with the support and resistance levels, this makes it an incredibly powerful strategy and system. Along with the strategies and systems that we use in the trading room, you really can't go wrong. So if we're at a heavy area of support or resistance, you can be pretty confident in your trades to either go to the upside with calls, buying at the money or near the money calls, and going to the downside, buying at the money or near the money puts. So that gives you that extra sense of confidence, extra level of understanding, and we really have some amazing products as well. Webinars and whatnot we've done in the past to explain all this to you, to give you the extra edge in your trading.
So
And also here, I just wanted to mention what's on the chart there. We there's buyers at the Andrew sliding parallel and buyers at the 50%. We see this every day in the trading room. We'll measure Fibonacci retracements. We'll measure Fibonacci extensions, and we will identify market turning points as well as symmetrical turning points that we can look at in the trading room to help you.
That's pretty good. So in the last 20, 25 minutes, we went everything from a novice trader to institutional traders. So I just want to say, don't get too bogged down in all this stuff here, folks. I know it's very confusing and there's a lot of stuff here. And if you're not really familiar with it, to be clear, Aaron actually has a course that he's recorded and it's available to you if you want it. So, we can get into it, but I think I'd like to reiterate that you do not need to know everything about the stock market to make some money. So there are some people who are very, they're really in tune to what Aaron's doing here, and they're making a lot of money doing what Aaron's doing. I know it can be very confusing, but once you learn this, it's not that bad. It's not all that hard either to learn. And then there's all the indicators that I use. Now, so when you combine these two, that's where you get this, that's where the saying comes from here. When our indicators unite, our trades ignite. There's a lot of truth to that. So Aaron's looking a little more, I guess, longer term, perhaps. Not really sure when it's going to happen, but we know pretty confidently that it is going to happen. And it's really good to be on the side of that when you're doing your day-to-day trades. So I might be going for those short-term breakouts, for those, those trades that are going to happen in a few minutes. And Aaron's going with those longer term. So we've got, we're going against with the wind on the whole thing when we're trading like this, if that makes any sense. So that's really good, Aaron. It's a really good presentation. I like that. So what's your next steps here, folks? What are we doing here? Well, you want to become an expert trader. You don't want to just rely on somebody else, although it's a good idea to rely on somebody else for your training and to have coaches in your back pocket, because you will need them from time to time. And it's very important, I think, that you have somebody who is actually on your side. So what are you going to do? You have to become an expert trader by, first of all, committing to mastering our proven strategies. And this is where I come in and say, look, you don't have to know everything about everything, because you will never know everything about everything in this space. It's just impossible. And when you think you know everything, they're going to pull out a new one, crypto or something. Like there's never going to be an end to any of this. So the idea here, and this was where I got my focus. I said, I don't want to be a generalist. I want to be a very special. I want to be a specialist. To compare it, and I've used this example before. Look, if I have a problem with my foot, I have to go to a generalist first, and he says, you have to go see my buddy. Here's go see this guy. He's the foot doctor. He or she knows everything about the foot, all the bones, the muscles, everything, and he doesn't know anything about the eyes, ears, throat, or anything else, but he knows everything about the foot. That's where you want to go, and that's what we do. So we rely totally on SPY all the time, options, and we're specialists in that. laser beam focused. So you want to master our proven strategies and accept the fact that long-term success is going to be a marathon. It's not a sprint. Every now and then I get people saying, well, I just spent a week in your with your trading room, and I don't know how to do it yet. So I don't think it's for me. So, well, wait a second. The people that do the best are the ones that have been for a year. And it's funny because this morning we were talking about, we had a little contest in our trading room. The person that can identify where the stock is going to end up the day, they get a prize. The prize was an ebook or something. And the funny thing is, last 2 days, the same person won. His name is Terry, and his last name is initial is W. And it's funny because I said, looking back, Terry was with us since 2015, or no, 2015, 2015, I think it was 2015. Yeah, 8 years he's been with us. So the longer you're with us, the longer you're doing this, the better trader you're going to be. That's just the way it is. So get in, get the commitment, do this thing. And again, aligned with competent, compassionate coaches that relate to you. All right, that's the important thing. You want to feel comfortable with your coaches. You want to make sure you're with some pretty good people here, and then stay with the program. Now, you may have to tweak a little bit to sort of facilitate your situation, your goals, your whatever. Not everybody's going to want to make $1,000 a day. Some people are going to be happy with $100 or $200 a day, whatever it is. We tweak it, and we work with you on all of this. Now, the other thing is what I'm going to tell you about right now. You can do is just simply join the inner circle. The inner circle, this is where every morning we send you right down into your inbox a consolidated pre-market analysis, and you get this around 9 o'clock every morning. So, and I'm going to give you an example. Aaron and I, we discuss, we show, well, okay, where's the market going today? Come the opening bell, where do we expect the market to go? And then we say, okay, I think it's going to go up. I'm interested in calls. I'm interested in puts, whatever. And that's what we do. We get in there. So find out what expert traders are looking to trade. What we do is we call we poll the market. We look at all these news feeds, Twitter feeds, all these various news feeds. We bring it all in, boil it all down, and in a very brief, concise report, we give you what we think is going to happen. We're also going to give you an afternoon market recap as to what we actually did, where the market went, and you're also going to be invited to our exclusive live weekly interactive training sessions. And these are recorded for later review. So bring your questions, any questions at all related to SPY options, we will address them in that. You can either email them to us in advance or simply ask us during that time. I don't know of anybody else who does that, and we do an excellent job at it. We've been doing that now since 2010. We're in our 14th year doing this. Here's an example of what I'm talking about with the inner circle right here, folks. This is this morning's market analysis. I don't want to read into all of it, but it's very brief, just a very brief synopsis as to where we see the market going. Give you some support and resistance numbers as well. And then a follow-up report. This is actually, I think, yesterday's. Follow-up report as to what we actually did, including our own real trades. Our pick of the day, our OMG, which is short for out of the morning gate. Our 10K challenge is a little program that we're doing, and also what I did personally. So this is what we what we do. We send this to you in your inbox every day. The inner circle, folks.
Yeah,
this is where you're going to get the benefit.
Yeah, those were last week. Yep. I think Thursday last week. Yeah.
Oh yeah, they are. So, but it's current, and every day we give this. Yep. You miss one, it's not a you're going to pick it up. You're going to get the benefit from experienced expert traders. This is all we do. All right, it's not like we do something else. I don't have another job. Aaron doesn't have another job. This is what we do, and we service our clients this way. And you're going to learn from our treasure trove of relevant tools that we use on a day-to-day basis. Let us do the heavy lifting for you. You know how much work, if you want to do a proper analysis, how much work that is? There's a lot there. Have your questions answered in our weekly meetups. Trade with confidence. That's what it's all about. Folks, you got a very special Eagle Financial Publications special deal for you on the inner circle. You cannot afford not to get this. Now, subscribe now for only $20 for the first month. You know what? $20 will buy you not even lunch today, not even lunch. And then after the first month, if you don't like it, just cancel. It doesn't matter. After that, $275 a quarter. That's unbelievable. That's unbelievable. Roger, I can't think of a better deal than that. No long-term contracts, cancel anytime, outstanding support team. You cannot afford not to subscribe. Again, $20 for the first month, $275 a quarter after. all you have to do is click the link in the comments section below here to join us. All right, and I look forward to seeing you in the inner circle, ladies and gentlemen. So all you have to do is click the link in the comment section now and subscribe, and we'll see you then. Thank you very much.
Yeah, but I think, we covered a lot of stuff here, and the reason we did this special introductory offer for Inner Circle is because this is a great way to get into what Hugh and Aaron are doing every day, and it's the best first step. And you do that first step, you start to learn more about it, you follow them, and then if you want to get into the trading room, that's a good second step, and actually be trading with them every day. But this is, this gives you the education, as those of you who have seen me before, I always stress education, education, education. That is what Eagle is all about. I firmly believe if you're better educated, you're going to be a better trader or investor, and that's what we're here to help you do. So, and as I've been saying all day, this is our last session, but I've been saying all day, if you've been watching us, the $20, there was a reason for that. It's because May is our 20th anniversary of Eagle Financial Publications, so that's why we wanted to do something really special. And $20 for 20 years. So we try to make it about as cheap as possible. Like you said, you can't even go to lunch. Two people at McDonald's cost more than $20, and you're going to get a full month of these guys. So click that link in the comments section now, and Hugh and Aaron, you'll be next to them every single day, live every Tuesday night. You have a live webinar with them where you can ask them questions. You're going to get the training. It's fantastic. So go ahead and click that button now to join us. And Hugh and Aaron, thanks so much for being with us today. And I want to thank everybody. What a terrific day! It's been a long day. I've been sitting in this chair all day. I am ready to go get a little get something to drink and get some dinner. But wow, what a great day it's been. I really hope you enjoyed it as much as I have. I hope you gotten a lot out of it. And be sure to subscribe to Hugh and Aaron's Inner Circle. And again, thank you so much, and I wish you a very profitable day.
Thank you, Roger.
Thank you, Roger.